I heartily welcome to our topic on valuation. We heartily welcome our speaker CA.HEMANTHA KUMAR sir to occupy dais. I request all to please rise for our CA motto song.
सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामुषो पुरुषो निर्विमाणः तदेव शुक्रं ब्रह्मा
Please be seated. Proof of video will be displayed.
Arthashastram, Dharmashastram cha, meaning economic principles Arth and ethical considerations Dharma, which are central to the work of accountants. The entire world is deliberating about impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the work, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOBAC, proudly presents before the World Forum of Accountants 2025. Accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhoomi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025, at the magnificent Yashobhoomi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhoomi, New Delhi. For more details, visit wofa.icai.org.
It's my pleasure to introduce CA.HEMANTHA Kumar sir, who is a practicing chartered accountant, promoter and founder of Ms. Hemantha & Co. Chartered Accountant Chennai. He is a member of Institute of Chartered Accountant of India. By qualification, is a diploma in Information System Audit, Insolvency Professional from IBBI, Qualified Registered Valuer, Qualified Social Auditor, so Qualified Independent Director, Registered at Director Data Bank, Certified Forensic Auditor from ICAI, Certified Concurrent Auditor for Bank, completed certification course on GST, on non-profit organization, on cooperative from ICAI. He has vast experience in the consultancy of audit and assurance service for both direct and indirect taxes and handling the corporate affairs advisory matters. Presently, editorial board member, Institution of Valuers for 2023 and 24, co-opted member at the SIRC Regional Council, IP and Valuation Standard Committee for the SIRC, convener for the Annanagar CPE Study Circle of SIRC of ICAI, co-opted member at the SIRC Regional Student Committee for SIRC 1920, so co-opted member at the Regional Council, editorial board for SIRC 60 and 70. The regular speaker on the different professional topic at the different CPE meeting and branches of ICAI, ICWAI, as well as the Tamil TV channel. Thank you, sir, once again. I request CA Amit Kumar, sir, to present the shawls and memento to our speaker. To the speaker.
So, in fact, this is the second session of for this current calendar year related to valuation. In fact, during the month of June, July, we have one session, full day session, which we try to give a feeling of valuation profession for chartered accountants and the developments in the valuation profession in India as a registered valuer recognized in India first time in the history. And related to chartered accountants, valuation related professional opportunities. If you see broadly, it will be Companies Act, first act, which is the bread and butter for us. And second act, which recognizes the registered valuer profession in India, is Insolvency and Bankruptcy Code. Follows with few more acts, SEBI, few sections are already started, and Income Tax Act, few. And like that go on, so on, different registration, more than 14 plus registrations in India, which require the requirement of a valuation professionals in India. If time permits, we'll discuss that also. So today we planned in such a fashion that covering all important three areas. One, the developments in IBC, related professional opportunities, and number two, in the Companies Act, mergers and acquisitions, which are very, very important. And the developments in the mergers acquisition, and post-lunch we will have our core area of valuation under Income Tax Act. So all these three legislations we are trying to discuss with us. Going to be a wonderful session for the day. So how many of you, before starting my latest updates on IBC valuation, so understand a little bit more about the audience so that the value addition and taking the subject interesting to the next level, I'll try my level best. How many of registered valuers in this electron? No problem. So, why I asked that question is to make myself, make you comfortable and understand the requirement of IBC valuation and where registered valuer will be taking place in the IBC valuation. And I'm going to cover what is the developments in the IBC valuation. And report writing in the valuation related with not only IBC, generally report writing styles in the valuation, and we'll cover the latest development which are happening in the IBC valuation, how to attack and how to address those set of points in the COC, Committee of Creditors. So, and time permit, we'll have to discuss professional opportunities for registered valuers also. So keeping that in background, so let me take you, first of all, understand all of us knows, and we should know by this, because nowadays it became very, very important topic. Even for that reason, even for CA final in law paper, it became very important topic is insolvency and bankruptcy code. The present government of version number 1, the significant and great reform related to debt recovery related issues and disputes, those type of issues, the government's taken the initiation and brought a wonderful legislation is called Insolvency and Bankruptcy Code 2016. To understand the Insolvency Bankruptcy Code, even before coming to IBC in place, this redress system of debt and creditor, so corporate debtor as well as company as well as the creditor, whether it's a financial creditor who lended the money for the company, or it may be operational creditor who provides service or goods to companies, is bifurcated. So 3 main important players in the entire ballgame of IBC. One, for corporate debtor, who is nothing but the company, and financial creditor, that's the financial institutions or any person who provided loan to the company, financial service to the company for a return of interest or whatever. And third category, of course, providing service or goods, supply to goods and waiting for their back of their whatever amount of recoverable, that is operational creditors. Earlier also we have a redressal mechanism through courts as well as NCLT, High Court, and which takes, everybody knows, over a period of time bound is not there. In those circumstances, and especially related to debt recovery, there is more than half a dozen legislations. For example, in Income Tax Act talking about one set of provisions. In Companies Act talking about one set of provisions, recovery mechanism. And different legislations have different set of recovery mechanism. To subsum all these things and put in a codifying into one thing, we come out with a very wonderful code called IBC, Insolvency and Bankruptcy Code 2016. The main important 3 pillars for IBC to understand in a better way. One, revival and turnaround the company's resolution and trying to do a resolution process. Through that, whatever dispute happened, that dispute has to be come to end, and maximization of assets of the company which has to be recovered. Whenever these type of situations, assets transfer and fraudulent transfer between the promoters and related party issues, and end of the day showing balance sheet nil, and when go to the court, end of the day court, nothing is there, so tata bye-bye, haircut, nothing, and you'll be, that is the normal standard of practice which is quite happening. To put a checkpoint for that, to address that particular point, Insolvency and Bankruptcy Code comes with things. And promote entrepreneurship, of course. The idea of IBC is not to kill. If somebody is not well, put in the hospital and first in the normal bed and some serious ICU, then from ICU straight away to next level and with a big charge. It's not the intention of the legislation. From ICU they want to bring back to the normal hall, and from there discharge with a solutional things of by using the expert called insolvency professional like you and me, and availability of credit, and making the life of the corporate debtor, the moment when he was chunked up with this all indisciplined, financially indisciplined, when all creditors are putting pressure on him, and end of the day we have seen a lot of cases where sensitive people will take a different type of decisions, things are happening, and company, entire family was disturbed. Those type of things for give a solution by giving a moratorium of 1 year until IBC case invoked will be realized. So those type of set of provisions were incorporated in the IBC and balancing the interest of all stakeholders. Stakeholders are invariably one, corporate debtors, two, creditors, that is financial creditor or operational creditor. Apart, public involved in operational creditor, all government sector organizations, all things will come. So the basic idea, as I told you, the IBC code is not to make the company to die. Once company is ill, a person is ill, again putting him in pressure and make him die is not the intention of the legislation. Intention is recovery and resolution process. Someone has to be given a treatment with a financial person like insolvency professional and bringing back to the normal life. So we may be having a question that for whom this will be applicable, IBC code. Presently, IBC law was framed in such a structure that into one, corporate insolvency resolution process, non-corporate insolvency resolution process. In the corporate, it comes under Companies Act and any other government law specified act. LLP is also covered in this, and any other body are notified the central government. Only in the case of individual, personal guarantee was taken, that is off late was included. Apart, these are the things are presently applicability is concerned. That means as far as IBC code, if you want to invoke, these are the set of people or these are the companies, corporate set of teams will be invoked. And presently partnership firms, the non-corporate like partnership firms, proprietary firms, individuals, small people, non-corporates are still not invoked. So that is the reason still the importance of the IBC code and valuation related to IBC is only a few set of people are doing. Because only in India we have a limited set of corporates are there. In the limited set of corporates, only those are coming under applicability and who are coming to the preview of IBC. And those cases were limited in sense. That is the reason the professional opportunities still restricted for the corporates. Just visualize, friends, if proprietary concerns and firms start implementing it, and how many number of cases will be admitted in the honorable courts, and how many cases it will come under DRT. If it is a IBC code for companies, it is NCL, honorable NCLT will handle it. And in the case of non-corporate, it is the DRT, it is clear in the law. So in the DRT, especially class B and C towns, just visualize more than the CA practice of day-to-day life, we may be having a cases for registered valuers to attend to the valuation for individuals, and it's a mandatory. Once case admitted IBC, it is a mandatory, no option. This is by legislation, it's required to do valuation by two valuers, registered valuers. Who are there? That will see it. So once we became qualified registered valuers, now then only we can able to do it. That also we'll see. So that is the reason the scope for the registered valuers for IBC related valuations we see only in the big towns and few B class, C class, even B class, C class towns when resolution profession was appointed in the cities. So invariably network will work out, and within the parameters we are getting the opportunities in the B class, C class. Still not up to mark. So what I'm trying to say is this is the right time. So a lot of changes are happening in the valuation profession, and the valuation profession, all 14 legislation which I told you, going to be again subsum, and one register valuer, one entity going to be happen. Draft valuer bill is already placed in the parliament. One session is over. Once draft valuer bill transformed is a valuer act, it may be 2025. Once that is there, like accountant means chartered accountant in India, cost accountant means cost accountants of India. The same way in India, any valuer means a valuer registered in the Valuer Act. Who is that Valuer Act? Presently registered valuers under IBPA, those are registered, who are going to be transformed and going to be having a nomenclature also prefix like ACA, FCA, like that fellow valuers, associate valuers. So all valuations in India, even for private purpose, even one or two small things presently left out for the chartered accountant, that also only a qualified valuer under Valuer Act going to be do the valuation. So right time to think and right time to take, transform the profession traditional, come out from the traditional, apart from keeping the traditional profession and having the professional opportunity in the insolvency and bankruptcy as an IP, and the registered valuer as a valuer under Registered Valuer Act. So these are the professional opportunities. So to understand it better way, furthermore for a few minutes to make you feel that what is valuation under IBC. There are the two stages of IBC valuation. One is a CARP process, corporate insolvency resolution process. Two, liquidation process. As I told you, one's case was admitted with the Honorable NCLT Court, and the flow I will explain you. The first flow of thing is CARP. Second flow is nothing but if it's not resolution process not happen, then it go for liquidation. So where is the valuer's role in these two categories? All two categories valuation is required. Especially in the CARP cases, within 7 days or before 42 days, two registered valuers has to be appointed mandatorily, and they have to do valuation. And at the same time in liquidation, it required, you can appoint the liquidator, the valuations. Earlier the valuation for admitting the case is 1 lakh rupee, now it is increased from March 24, 2020 to 1 crore. In the case of MSME, it is 10 lakh rupee. So to understand it better way, there are 3 Ds. Recently we seen 3D movies also, no? So drastic movies. So 3D we can keep in mind. So 3D, what is 3D? One is debt. For any, obviously, naturally. For any transaction between, there is a transaction of debt, it's a financial debt or operational debt between the financial creditors and corporate debtor. That means corporate debtor is not company. Financial debtor, corporate debtor, or operational debtor, corporate debtor. So any debt transaction should be happen. That is a primary condition for admitting the case into the IBC. Obviously, there should be a reason for the case. 2, if it is a smooth transaction, no question of resolution dispute between the two people. Industry, you are good, I am good. When you are not make my payment within due date, you are not make your commitment fulfilled, then only issue will come. That is called default. So that should be there. That debt became default, and at the same time there should not be any dispute. Here all our chartered account friends should be make advisory to our clients. It's very, very important advisory. So any of your clients wants a redress mechanism of IBC code. These are the 3 steps, initial steps to be taken care. 1, debt, obviously book entry will be there. Default on due date. On due date, whatever 60 days, 30 days, whatever due date committed by the as per as engagement, that due date, the default has to be taken. And the communication, there should be a formal communication. Oral communication obviously be there, but before court of law, evidence is required. So formal communication between these creditors and company should be captured in the client's record. Oral, yes, but at the same time, having in the court of law to prove, that means you followed for the payment, then he was drastically defaulted in making your payment. So this documentation process is very, very important to capture, to go for the next one. So if any dispute or still negotiation is going on between them, then NCLT court invariably will not accept. So that is the reason 3 Ds. 1, there should be a debt, it should be defaulted, and there should not be any dispute between these 2 parties before proceeding to the next level of NCLT to admit the case under IBC code. So keeping that in 3, the case was taken up, and a few definition if you want to understand. Adjudicating authority, NCLT, National Company Law Tribunal is the adjudicating authority, supreme authority. Corporate person includes a company, limited liability person, which are the applicable categories which I already told. Corporate debtor, number of times I made you to feel corporate debtor. Creditors, both the financial creditors and operational creditors. Committee of creditors, I am introducing one more word called committee of creditors. Very important, interesting. One's, okay, I'll explain you that one. So committee of creditors is a set of members between the creditors having a meeting to understand the resolution process. Insolvency commencement date, the date court NCLT accepted your case is called insolvency commencement date. CIRP date. This is very important date. CIRP date. Interim resolution professional, the person who was for the 30 days, part-time appointed person, the insolvency professional is called IRP. And resolution professional, applicant, who are applied for that either financial creditor, operational creditor, resolution plan, related party. Fantastic. Now I'll take you for a few minutes the flow chart of CIRP process before taking up the valuation, core valuation of the. First one, filing application of CIRP. As I said, there should be a debt and there should not be a dispute, and there should be a debt, default, dispute. If three categories are fulfilled and this default is more than a crore rupee, then the agreed person can be approached the Honorable NCLT by filing an application in a prescribed format. After putting application form, acceptance by the NCLT, the opportunity will be given for the corporate data. This is the case to prove you, is it correct? If true, then application will be accepted. Then once application is accepted, the court will appointed, NCLT court will appointed IRP for a period of 30 days to make initializing, standardizing the things to take the control from the corporate data to this insolvency professional. That is nothing but IRP initially. Constitution of COC by IRP. As I told you, these creditors who are the financial creditor have the right to vote in what to do next. So default is happened. That means, as we are aware, company is an artificial person created by law. On behalf of the shareholders, the trusted activity of management is given to the board. When board drastically failed in fulfilling the commitment of financial creditor and operational creditor, obviously board is incapable to run that particular trust is gone. So that is the reason the moment the CIRP process is taken place, the board of directors will be suspended, not removed, suspended. Suspension order with that, there will be month. They will be suspended, kept aside, but they have to help for the process. That's all. So when board is absent, equivalent to board, there should be one committee should be organized. That is the idea of the legislation, to have a committee called COC, Committee of Creditors, because after shareholder in the balance sheet also you can see the next level of people who can have the ownership indirectly is who are given the financial credit, bankers. So that is the reason first priority is given for the company board of equity shareholders, on behalf of them board of directors. Second, financial creditors, on behalf of them one committee will be formed, and for that committee will form by the IRP, that is called COC, where decisions has to be taken, and after 30 days having paper advertisement, other formalities, and collect the invitation of loan amount from the different creditors, and they conduct one, RP will conduct one, RP will be converted, and RP will appoint professionals, registered valuers, as well as whoever required for the smooth administration of the process of the this IBC code. So the required professionals has the powers to appoint, and ensuring the compliance of shareholders, stakeholders, communication, and preparation of memorandum, and inviting for paper advertisement through inviting for interest to the resolution process, who are the resolution applicants, and putting place in the COC. If COC accepted the resolution plan, then that plan will be implemented. Once it is bring to the notice of NCLT, that is over. If at all the resolution plan which proposed, the offer which they are getting by the COC, which is not competent, which is not attractive, then obviously CSC can go for an offer of going for liquidation. So first stage, they are trying to do some resolution mechanism. Through resolution mechanism, they are trying to bring back to the company the normal and run through, and again handing over to them to a resolution applicant who are able to interested and ready to do it. If that does not happen, then it will be back to a liquidation process will be started. Then liquidation, again the same process. Liquidation is, as we are aware, there will be liquidator will be appointed. This RP became liquidator, or a new person may be appointed as a liquidator. This liquidator job is again valuation he has to do up to date, and identify the assets value and list down the value, and identify what is the outstanding of the value, and how much per creditor will get it, how much haircut will be deducted in each shareholder creditors, and finally in the flow of there is a mechanism which already IBC is prescribed, water flow of mechanism. First this people, this people, this people, this people, like that. The flow of money will be distributed, then finally company come to an end. This is the entire process of IBC. It is superseding all legislations which I told you, more than half a dozen legislations. So IBC is the supreme law. So keeping that background, this is the flow of IBC. Any questions meanwhile? So. Okay, fantastic. So after understanding,
It consists of only financial creditors or all creditors?
somebody can give me. Yes, sir.
COC consists of financial creditors only, all creditors, or any combination, or weightage will be given more to financial creditor, a quantum of outstanding. What is the
Correct. So in the COC, the voting rights will be given only for the financial creditors, but operational creditors can participate only in few situations in the house builders association, specified category of the registration. Only operational creditors will be given the powers, but they can participate in the COC. But voting rights first prima facie will be given for the financial creditors.
Suppose the financial creditors have minimum part, say their stake is say 10%. Whereas operational creditors have the stake of 90%.
Correct.
Say 1 crore is the financial creditors, as 9 crores is the operating creditors.
Correct.
So if whether you are giving
First priority will be first priority, and even flow also will come to the financial creditors.
That's okay. Voting rights we are giving to only financial creditors means the financial creditors may be secured or unsecured.
Correct.
Okay, in that case, how the unsecured creditors?
That's what, sir. That IBC code mein legislation certain provisions are already mentioned. That will be taken as per as the regulations of IBC only. Yes, sir.
Can a guarantor in a company who was given personal guarantee can go for IBC?
Yes, that's what. Only for individual personal guarantee, for individual invoking, yes, still it is already on.
Instead of invoking, to go for the liquidation.
That's what, sir. That's what. If nobody applies, nothing money comes out after completing the process of IBC of company. So if personal guarantee was given by any individual director for particular thing, that definitely still that is open. It's an opportunity for the before NCLT can be taken, process can be done.
Not by the director, it is one of the shareholders.
Anybody else, shareholder, anybody, any individual personal guarantee. Personal guarantee, that's what personal guarantee.
Because the company the
personal guarantee, that's what I told you, sir. No. I'm sorry. Only personal guarantee to the corporate. For who are given personal guarantee to the corporate, that is open. For individual, like directors, individual things is not applied. Only when you give a personal guarantee by anyone, individuals, that can come under the preview of IBC preview. It's open.
So they can go for the liquidation or which process?
Yes, that process, entire process will come. Depend upon whether resolution stage it will happen or personal liquidation. So depend upon situation to situation, sir. That can be invoked. That's what I'm trying to say.
No, it is not for the purpose of invoking. It is for the purpose of
correct. It invoking and
resolution
process may it will be used
to further stake sale.
Yes, sir. Can be done.
Suppose by a company, somebody is given personal guarantee. Say the director is given a personal guarantee.
Yes, sir.
Okay. So his property is attached by the IP professionals. Okay. So now he can step to the shoes of creditor now. So I have given 1 crore to the corporate guarantee given to bank. So the bank has attached my property, say. Okay. After taking my property, so now the company owes to me in that case, no?
Creditor. So your related party. Basically, your related party.
Whether I may be treated as a creditor in that sense.
Yes.
So
yes.
Now I can apply to the.
You have to apply as a creditor.
As a creditor.
Yes, sir. One application as a creditor you have to do, as well as the invoking process will be there. There is a protocol in the IBC code. As per as the norms, it will be taken, sir. Both things happens. Good. So up to 17/10/2018, That means in 2016 when registration of IBC code came, and 18/10/2017, companies that started notified registered valuers profession in India. So in 2017, after that some examination price and all these things, effectively December last or 1st of 2018, registration process is started. May 2018, valuation process is started effectively. So registration entries are happening. From that period, what happened is still there is no clarity in the IBC code who will be the registered valuers. Even chartered accountants are appointed as the registered valuers and proceeding it. And in the court of law, the valuations are not coming in process, and the result it is extending further more on things. So IBBI come out, as I told you, in the Insolvency Bankruptcy Code, the adjudicating authority is IBBI, Insolvency and Bankruptcy Board of India. So the same people were appointed as organizations appointed in the same October month 23rd within a period of 5 days as in charge for taking care of the registered valuer profession. So IBBI come out. So from February 2019, only a qualified registered valuer who are registered under IBBI is only a competent authority to do the valuation under IBC. So repeat, from February 1st, only a qualified registered valuer who registered with IBBI is only a competent authority to do the valuation under IBC code. So through that notification, they come out with what are the areas valuation professional opportunities are there. In the law, registered valuer means a person registered with as such in accordance with the Companies Act 2030 and rules thereon, so on. And these are the professional opportunity under IBC code, CIP process and liquidation, fast track. So different type of voluntary liquidation. So all this category, more than 7-8 circumstances required requirement of a registered value under IBC code. And these are the things, regulations are related to valuation. Now, in IBC, I told you, very quickly I'll make you to feel the two process of CIRP as well as liquidation. In CIRP, there are only two major regulations, regulation number 27 and regulation number 35. 27 and 35 is the only two things mainly related to valuation profession is concerned. 27 talking about appointment of, earlier it's the valuers, now of late it's changed as a professionals. 27 talking about the resolution profession shall within a period of 7 days of his appointment but not later than 42 days from the date of insolvency commencement date, appoint 2 registered values to determine the fair value, liquidation value of corporate debtor in accordance with the regulation 35. So they are quoting about 27, 35, how to do valuation of fair value, liquidation value, 35. But appointment made it very clearly. So valuer appointment will be done within a period of 7 days from the CRP date, maximum to maximum 40 days from the CRP commencement date. Because all this IBC code runs through a time-bound process. So that maybe IRP appointment, after that COC committee formation, collecting the debt and finalizing the numbers, and resolution process, valuation. In this valuation is very critical area to arrive the values of assets. So registered valuer will do only a valuation of assets. Liability is not his job. Liability is the job of the resolution profession who will do the valuation. So in balance sheet, our responsibility will be laying only on assets. Which assets? Again, assets are classified into 3 categories of assets. 1, registered valuer, land and building. 2, registered valuer, plant and machinery. 3, registered valuer, securities or financial assets. So we are security and financial assets. Land and building, very clear. Who are related to in the balance sheet, land and building, if it is there, it will appoint only a qualified registered valuer. We can't do the interchange of valuation. Small value of small things also, you are not competent person to do valuation. Law made it very clearly. So land and building, plant and machinery will be done by the competent authority, and remaining assets in the balance sheet will be taken care by invariably by the securities or financial assets. So who is the qualified person? We are the qualified CS, CWJ, CS, having 3 years of experience, etc., etc. You know the process. 50 hours of training you had to undergo with RVO, first step. Then after registration, then you had to go for online examination. After completing the online examination, registration process, you can start your practice. So these two registered valuers are mandatory to be appointed. Who will not be appointed? Related party will not appointed as a valuers. Who is the related party? Relative of a resolution profession, related party of the corporate data, auditor of the company. Auditor of the company should not do the valuation or IBC or anything. He is a related party. A partner director of the insolvency professional entity. That means if RP is already appointed one entity or RP, if he is having his own CA practice, his partner also not eligible and he is a related party. So as usual, to keep professional independence and keep the professional work independently to done and arrive a true and fair valuation number to be arrived, that is the intention behind that. Once registered valuers are appointed and invoice for fee and other expenses incurred by the professional appointed under this regulation shall be raised in the name of the professional and paid directly into the bank account of such professionals. From this lesson, what we can understand, if your partner is a registered valuer, try to not try to. Legislation says very clearly that professional activity related to valuation should be raised by that professional, not by your firm. So if any income tax valuation firm is done, then you can competent to raise the invoice. But under Companies Act or IBC code or any other specific legislation which is required by the law, and a specialist like your partner or you done the valuation works, you have to raise your invoice in your professional's name only. And that money, professional fee should be transferred to their account only. That's what the legislation made it very clearly. So basically 27 talking about the appointment and fair value. What to do valuation? The value has to be valued. What generally we will do the valuation is not a new for us. We do valuation daily on inventory valuation and investment valuation. All things we used to do it. But here, there are two languages we have to arrive. One basis and two premises. What is the basis of valuation? Basis of valuation, fair value, liquidation value. In the case of CARP, premises will be going concern or liquidation. If it is a fair value, going concern, liquidation, and liquidation value. So what is fair value means? Estimated realizable value of asset of the corporate data if they are exchanged on the insolvency commencement date between the willing buyer and willing seller in the arm's length transaction after proper marketing where the parties acted acknowledgeably, prudently, without compulsion. In simple language, what they're trying to say, as a valuer you have to visualize, even those few companies may be not functioning by the time when case for CRP is admitted, long back, 2-3 years back itself, operations are stopped, no functioning. But here, we as a valuer, we have to visualize it and we have to arrive at fair value on going concern. If at all company was going concern, what could be the value on fair value will be arrived on exchange on the insolvency commencement date. That means valuation date. So now we can learn the valuation date, purpose, and basis, premises. These are the technical terms which is required for every chartered accountant is required. In I believe 2018, May, as I told you, May started when things are happening. So Institute of Chartered Accountants of India come out with like accounting standards and auditing standards, valuation standards also they issued it. So every chartered accountant, it is not optional, it is mandatory. Since our topic came, this is the valuation standard. Can you help me? This is the valuation standards. Wherever chartered accountant required to perform any valuation, valuation required to be done as per as mandatory under valuation standards issued by the ICAI 2018. There are about 8 valuation standards. It's very easy to understand and easy to read. These are the valuation standards. Yeah. So 101 talking about definitions, 102 talking about valuation basis, and 103 talking about valuation approaches and methodologies, and the scope of work, reporting, business valuation, intangible and financial instruments. These are the initial 8 issued, subsequently not added any further. But any member who registered with the ICAI definitely due to valuation required to be follow these valuation standards. So I request all the members at least have a look and make ensure that in case until draft valuer bill transferred as a valuer act, wherever valuation opportunity for a chartered accountant, you mandatorily required to be follow these valuation standards and should mention in your valuation reports you prepared valuation as per the valuation standards. And coming to the registered valuers, no option. Members registered with ICAI RVO, there is a subsidiary of ICAI which is mainly for incorporated for and registered with IBBI. And members who qualified registered valuer examination, presently we have 15 to 16 registered valuer organizations where you have to enroll as a member. So being a chartered accountant mother institution, we used to register with ICAI RVO, where ICO RVO members mandatorily should follow these ICAI valuation standards for the standards for preparation of their valuation reports as well as valuation works. Whereas in case of other registered valuers other than chartered accountants in India who are chartered accountant also can register with other RVOs, but chartered accountant registered with ICAI RVO mandatorily should follow these valuation standards, because these particular valuation standards required when performing in valuation reports. When I discuss that area, we'll discuss. Very interesting things are covered. It is more or less keeping the background of international valuation standards. So this is for your understanding. These are international valuation standards. These are the international valuation standards. Invariably, most of all RVOs other than ICAI RVOs adopted IVS, International Valuation Standard Council, which are issued IVS. We keep as international valuation standard all big reports you might be seeing. These are the international valuation standards in India. Most of the RVOs are following. The present scenario of valuation standards in India, as per as the Companies Act, made it in the regulation number 8, talking about valuation. Whenever registered valuer doing valuation, valuation has to be done as per the valuation standards. Then where is the valuation standard? Presently, a valuation standard committee was formed by the central government, and they are working out with the Indian-based valuation standards for notified by the central government. Until that, the valuation standard adopted by the concerned RVO or international valuation standards adopted by RVO has to be taken into. So that is the reason ICAI RVO members will be following ICAI standards, and other than chartered accountants or ICO members, RVO members who are following the international valuation standards. So I repeat one more time, valuation standards are very important. If time permits, you can download this and have a look. And wherever opportunity to do the valuation in your professional work as in the capacity as a chartered accountant, you require to follow this valuation standard mandatorily. Okay, now you understand what is valuation standards, then we'll go back again. Okay, we understood what is the fair value, then we understand liquidation value. Liquidation value means estimated realizable. So valuation is estimation. It's not a scientific way of rocket science. Valuation always is an estimation. That is the reason valuation means estimate of realizable value of asset of corporate debtor if corporate debtors were to be liquidated or insolvency commencement date. Technically on CIRP date, no company will be liquidated, but being a register valuer, you have to visualize if that corporate debtor liquidated on CIRP date and order date, what could be the realizable value which comes, we have to estimate. That is called liquidation value. After understanding that 27, we'll go to the 35 very quickly. Fair value, liquidation value. How to do calculate fair value, liquidation value? The entire essence of IBC valuation. Fair value liquidation shall be determined in the following manner. They are given a set of rules and regulations how to do valuation of fair value and liquidation value. Two registered valuers appointed under regulation 27. That means I already told you, once IBC case was admitted, two registered value has to do independently. Independently, there is no joint meeting. Independently, they have to do a valuation separately. And resolution proposal, estimation of the fair value and of liquidation value computed in accordance with the internationally accepted valuation standards. Just now I told you, I showed you international valuation standards. So being a valuer, you have to do valuation as per the registration, IBC code. If IBC code is legislation is superseding of anything else, so as a base prima facie rules and rule of thumb, so here also we have to do valuation as per as the internationally accepted valuation standards, the fair value and liquidation value. Provided that resolution profession shall facilitate a meeting wherein registered valuer shall expedite the methodologies being adopted to arrive at the valuation to the members of the committee of computation of estimates. Friends, I told you the latest developments in the valuation is this. That means registered valuer. Earlier what will happen? They will appoint the valuers, will do the valuation and will submit the report confidentially to the resolution professional. But from February 15th, 2024, this amendment was taken place and a new clause was included to test the challenges and presentation skills of a registered valuers. So registered valuer, so provided that resolution professional shall facilitate a meeting wherein registered valuer shall explain the methodologies being adopted to arrive the valuation. That means there will be a committee of creators, you will be facilitated and you will be invited for the meeting, additional job for the registered valuers. So we had to go there, we had to give a presentation to the COC, and the COC they will ask you, since they are asking, you are telling, they have a liberty to ask you the questions. And what you have to do the job in the presentation, they made it, law also made it very clearly, valuer shall explain. What is your job in the COC? To explain the methodology being adopted to arrive at valuation to members. So today they appointed, tomorrow they call for a COC meeting. You have to explain what is the methodology, you have to do it in the valuation. Same practical impossible, number one. Number two, you don't know much about the company. And number three, invariably IBC cases, data will not be available. As I told you 2-3 years back itself, a company operations stopped, no accountant, no operational person, no office boy, nothing, only director will be there. He is also on leave. Nobody will be there, no office, it's not open, you have to wait. So in this keeping that background of practical difficulties, you have to go and explain what is the methodology. Unless otherwise the prime data you understand and you know that what methodology will be applied. Methodology is nothing but what sort of approach, what sort of methodology used, methods used to arrive the valuation. In valuation, internationally accepted valuation as well as Indian valuation standards, there are 3 types of approaches. Just for understanding, there are 3 types of approaches to do the valuation. 3 approaches are cost method, cost approach, market approach, income approach. So these are the 3 internationally accepted approach as well as ICAI also recognizes 3 approaches only. Each approach will have a different methods. For example, cost method, cost approach. Cost approach means nothing but simple, nothing but asset managed liability, intrinsic value, number of shares. Cost approach, simple. Market approach for his layman understanding. I am not going to in detail about that, but technically to understand our audience, to make it simple. Market approach is nothing but apple to apple comparison. For example, what is my value of my property at Arumbaka? My property is some X amount. How I know X amount? I purchased 1 year back. Because next to my door, same level of building, same level of face, same level of thing, and some approximately recently one transaction has taken place, say 2 crore rupee. So I can give some estimation saying that, keeping that adjustments, market adjustments of my building is further new, my building is front, dimension is okay, Vastu is good, road facing. So all these criteria will be taken into for doing a discounting factor, and we can arrive a value. That is market approach. Income approach, today I purchased this building, what for? For a period of time, this building I am going to go for rentals and going to generate revenue. After, let us say, period of 10 years, this lifetime of the building, a residual value will come, and residual value, discounting to present value, and bringing into the value under invariably DCF. You will be seen discounted cash flow method is a method for income approach you will follow. So we had to tell to the committee of creditors, this is a new legislation, new thing, new additional job for the registered valuers to have to test the presentation skills as well as your in-depth knowledge on valuation. They may be asked whether how many valuations on IBC you done, how to do it, why you done like that, why. So all this question may be encountered. So unless otherwise you clear about what exactly you are going to do and what is the value you are going to get. Yesterday appoint, today they ask you what is the value. So you have to tell. And one of the only thing is never ever we should disclose that in this entire process of IBC, valuation estimates are secret. It is not a public document. It is not a public document. It is not open number. It is a secret number. It will be very secretly should be provided to confidentiality. We have to provide email as well as report hard copy to the RP only. You can't disclose this report to your friend or your colleagues or anywhere in the public. You should be very confidentially. It is if you are not giving, you are breaching of the code of conduct. And you not forget about code of conduct. You are breaching the law and you will be seriously punished. So this is a new latest development in the IBC code that registered valuer has to, facilitated by the RP, you have to attend that meeting, COC, and you have to present what is the methodology you are going to use, and what expectation from you, what is expected for you to take it up. And 2 estimates of value in the asset class are significantly different or receipt of the proposal. Appointed third valuer, committee of the creditors, the resolution profession may appoint third valuer of assets class for submitting the estimate the value. What is asset class? What is the difference, substantial difference? That means 2 valuers as in our story, appointed 2 valuers, and 2 valuers independent I told you, will calculate the valuation. I'll say that the value is 10 crores. My friend will give a valuation 20 crores. I'm telling 10 crores, same asset, same story, but I'm telling 10 crores, he is telling 20 crores. If you ask, it's an estimation, it's my judgment. That is the reason the principles of valuation standards are in place. If you are following the whole purpose of the valuation standards or any standards, because whenever we are doing valuation, professional related services, there should be a standard to be followed, mechanism of doing valuations. If myself as well as my friend both are followed the systematically valuation standard of each asset, and definitely there may be a slight difference, but it cannot be invariably significant different. What is significant different? Quite some time having a confusion in the industry. 25% is the if a difference between my number and his number having more than 25% more or less, then third valuer will be appointed, and nearest of the third valuer and this number, that will be the taken average of that will be taken as the value of fair value and liquidation value. No one interested for the third value because it is a time consumed, cost consumed, and of course you are required to be explained to the COC that earlier it is not that. Now we are required to be explained why your number, you can't take your own way, my number is number, why, how you arrive the number scientifically. And end of the day, accepting, not accepting this COC decision, we are not interfering with that. So this is the latest development where again 25% difference is that third value will be appointed and average of the two will be taken. After receipt of the resolution plan in accordance with the code and these regulations, resolution professional shall provide a fair value, liquidation value, and valuation report. Earlier valuation report is not there, it is included now. To every member of the committee of the electronic form, in the electronic form, after taking the confidentiality certificate from each member and declaration from the member, and RP will be sending to the all. So you will sending the flow of report to the RP. RP after taking the confidentiality of the report, declaration from COC members, then he will circulate to the fair value, liquidation value for the COC purpose. Then resolution provision, registered valuer shall maintain confidentiality of the fair value and liquidation value. It made it live self. You can't disclose the fair value, liquidation value as a public document. It cannot be open for all members. It should be very confidential. Confidentiality, what is confidentiality? All these things, case stars are there, which I don't want to bore you. And this is in the case of liquidation, more or less the same set of rules, 27 and 35. In liquidation, same estimation of two things will be taken. At liquidation will come, IBC case when resolution plan is filed, then only liquidation will start. When liquidation is started, then the process is like this. Again, if he is okay with the numbers of old one, or else he can go for two more fresh valuation or liquidation. In the liquidation, valuer has to do valuation and arrive a estimated realizable value, their fair value, liquidation value. Here, only a realizable value has to be arrived. Realizable value is nothing but how liquidator going to dispose the assets. It may be piecemeal or it may be slump. It may be like depend upon the category of assets. If it's a perishable thing and immediately has to take into. Depend upon the mode of operandi decided by the liquidator. There is a mechanism in the IBC code how to disposal way of things in the law. As far as the things which will be disposal will be taken care. And very importantly, here also, if two values are appointed, third value question will not come, and average of the two will be taken in the numbers, and it will be taken into. The latest amendment in the liquidation process, again, regulation number 5, where valuation undertaken regulation sub-regulation 2, the liquidator shall facilitate a meeting. Again, in liquidation, there is a meeting. Again, you have to go and stand before COC. There are no COC. Their stakeholders meetings will be there. That methodology and adopted for the valuation to consultation constitutional committee for before the finalization of the valuation report. So in the report, in the meeting, never ever disclose the numbers. Only you are expected to be disclosed and discussed only the methodology, what you are going to adopt to arrive the valuation, but never ever you should disclose the number. So in COC, few COCs are few members are intelligent COC members. Bankers will ask questions. What is the number you are going to estimate it? You tell me estimation only, sir. You tell me some number. They'll catch it. So then we have to fire back. It's not my job, sir. You are not supposed to disclose. It is not. We are not supposed to. It's a confidentiality as far as the IBC code. Single word. Again, instead of arguing with them, then they will say that commencement has happened. The CARP process is ordered 1 year back, but maybe taken 1 year process. Now, what is the use of going back and doing CARP date? You do the valuation today date. You are not supposed to do it because as per the legislation, it is a prescribed legislation that valuation date should be on CARP date. So CARP date is the date where it has to be taken in the case of CARP. Liquidation is the date will be mentioned there. Again, same concept, 25% of differences, and that will be taken into. So what is the consequences and what is the necessity of standardization of valuation methods in the corporate insolvency process? See, it's very important in the entire exercise of the CRP process that if you are arriving excess number or short number, it significantly influences. Excess more danger. No excess of taking food, sleep, or anything, excess of anything in the life is not acceptable by the body. System I say. The same way in the IBC code also, excess numbers given by the valuer, definitely it will significantly influence and spoil the core intention of the legislations, stakeholders. So arriving the exact number, the responsibility in the holders of the registered valuer. And next question will come, as I told you, 3 approaches in the valuation. Whether all 3 approaches required, because invariably in significant cases, IBC, it will be like more or less operation is stopped. When that is situation, what is the position of 4C of income method? But you have to have a discussion with the management. What are the 3 possibility of the thing? What is the RP's views and corporate data's views? Based on the circumstances only, decision has to be taken into. And assumptions, special assumptions, very interesting things while doing your valuation works are very important. There is no prescribed format for valuation, but there are mandatory content, compulsory content which are mentioned in the valuation report. In the Companies Act, law made it very clear that there is no prescribed format for valuation report. I am going to take you for this valuation report format for next 10-15 minutes. After that, I will take a break. Okay. After that, we can take, somebody can ask him professional opportunities of valuers. That also I will take 15 minutes, 20, half an hour I will take that. So, valuation report, very interesting, whether it's a valuation report or any other report or internal audit report or any report. But coming to my content of contest of valuation report, in the Companies Act, there are set of mandatory contents to be mentioned in your valuation report. Being a valuer, not required to request anyone. Of course, now today, if you ask ChatGPT to give you wonderful, ask ChatGPT, IBBA format, valuation report, wonderful report to you. Make sure that all these points will cover. Before that, even then it covers whether the few points left out possibilities are there, because they give a disclaimer saying that it is not correct, consult in the proper way. So, to understand in a better way, what are the main contents, mandatory contents? If you put all the contents in a checklist format, fill in the blanks, you will get a wonderful report. The same way, IBBA come out a guidance note. Only one guidance note in India so far issued by the IBBA for the registered valuer. Caveats limitation, use of the caveats limitation disclaimer. Wonderful document. So 16-17 pages. Everyone of us should read. What are the caveats, limitations, and disclaimers to be used in your wherever we are issuing independent reports. So those cases, these caveats, how to use limitations, we ought to use and disclaimer, how to make ourselves protect ourselves before court of law or any other cases, circumstances. So in that they mentioned very clearly what are the other few more contents required to be mentioned in the valuation reports. So these are the contents, background of the information of the asset being valued. So any report for the sake, first and foremost index, giving that what is the background of the, for what purpose you are doing valuation is drawing as per as the Companies Act for the purpose of professional development, valuation doing for the purpose of mergers and acquisition under section so and so, so and so. So purpose of the valuation and appointing authority. It is very interesting. In the Companies Act, who is the appointing authority? Generally, any valuers, auditors, all of us knows. But valuers generally, whenever you are doing valuation for income tax purpose, who is appointing? Your good friend in the CFO in the organization or manager in the organization will call you and ask you, boss, get me one valuation. This is a number. He will give the prescribed number also. Get me this number. Whether it fit into that format, whether it fit into that this thing, will is bothered, but they want this number. This is general practice happening in few cases, not all cases. But who is the appointing authority? By mistake, you know, anyone? Valuers, registered valuers? In company, yes, sir. Insolvency provision for IBC case, sir, for registered valuers. As far as Companies Act, registered valuer, who is the competent authority to appoint? Board of Directors, yes. If a company has audit committee is the competent authority. If company not having audit committee, then board of directors only the competent authority. Your CFO or CEO or your good friend, somebody else is not competent authority to appoint you. So as a registered valuer, your competent authority, you should get a board resolution has to be taken place, or at least a board has to be authorized somebody to execute on behalf of the board to do the valuers, and registered valuer will be appointed only by board of directors, in case no audit committee is appointed. And that is very important. That is the reason you have to mention your valuation report also. Who is your authority appointed, board appointed, so and so, wide resolution number so and so. And basis of value, as I told you, basis fair value, liquidation value, or depend upon the market value, fair market value. So what are the things required to be done? Basis has to be mentioned very clearly. Premises is a going concern, liquidation, forcible liquidation, all these things has to be mentioned in your report. Identity of the RV and any other experts in this valuation. I, Hemantha Kumar, registered valuer, registered with the IBBI, so and so number. Along with me, apart from me, no other experts are involved to do the valuation, or the expert under land and building, expert under IBBI valuer under plant and machinery. Who it may be you taking the professional service, not only registered valuer, even artificial for IT company you are doing, you are taking requirement of a technical IT guy for expert to the dumping of the data or any other sort of technical advisory things. So definitely you can use it, and those type of things professional services experts using the work of expert should be mentioned very clearly. And intended user of the valuation, very, very important. Valuation is not, report is not for open. Valuation is not a scientific number, I told you. Valuation is estimation. Valuation is estimation. This valuation, who are the intended users of the valuation? And invariably who are the appointed? You can't keep this report open for everyone. This agree only for diabetic. Make it very clear. So, like the same way, this report only intended for these people. You can't keep open. Then tomorrow some shareholder will come and ask you, okay, because of based on this, I invested entire my life of earnings in this company, and I became like this in the road, and you are responsible. No. So make the intended users very clearly in your report. Disclosure of RV interest. I told you independency. You should not be. You should be independent, and no conflict with the company where you are doing valuations. And date of appointment, valuation date, date of report. So of course you all of us knows date of appointment, and date of report, signing date, all of us knows. Valuation date. Valuation date, what date? What is the valuation date? Is it the same day of your appointment, or it can be earlier, or it can be future? A question again. Valuation date is the date of your appointment, or valuation date can be before backdated, or it can be future dated. Cannot be backdated. Any other views? For example, today 23rd November, appointing us. Backdated date, that means the valuation date can be backdated. That is the 31st March 2024 is the requirement of valuation. Can be done? Any views? No. CRP date is a backdated, definitely backdated. It cannot be after 7 days only it can be appointed. Again I repeat. So for example, income tax hearing has taken place for assessment year, let us say 3-4 years back assessment year, 2021 assessment year. Now you are appointed to the valuation for income tax purpose. Can you do valuation date today date or that date? No, saying that today only, but valuation will be done for that date or today date? That date only. It cannot be for today date. The purpose is not there. So valuation date is the date like balance sheet date. Today you are signing the balance sheet, September, for which date? 31st March 2024. So valuation date can be related to back period, not backdated, back period, probably your language will be splitting like that, back period. But at the same time, evaluation date can be future periods. Probably board may be asking you to do evaluation for 31st December 2024. For a multinational company, they want to do valuation. Board is formed today, and they're appointing you as a valuer and do the valuation for the future 31st December. That means after completing 31st December 2024, your valuation date will start. So these dates are very important. You have to mention in your valuation report also date of appointment, valuation date, and date of report. Inspection and investigation undertaken is very important. So wherever you are taking, especially wherever stocks involved, law made it very clearly. When stocks are involved, physical verification of inventory of any intangible assets are mandatory. You can't do the desktop valuation. Sitting here doing valuation, desktop valuation. That's not permissible. Invariably we do the desktop valuation, but as a security person, but wherever assets are there, you mandatorily required to undergo for and any deviation for physical verification of thing, you have to give explanation in your valuation report. Then coming to business interest, ownership characteristics, and of course you have to give a brief of, you have to understand the background of the other side, background of the client, and you have to have your SWOT analysis, and before moving to the approach. First stage appointment, and after appointment you have to do some set of protocols to before arriving the approach, which approach I have to follow, cost, market or income approach. Before taking the decision, I had to complete some set of protocols of to understand to what is the basis for completing that decision has to calculate. So that is the reason we should know about structuring, whether debt-free, you might be studied mixing of debt without debt. So all these things you know that. And natural source of information. So from where you got the information, company, ROC, or whatever. Significant assumptions, whenever you're doing, data will be always, there will be a requirement to do the valuation since it's the estimation. Some assumptions, criteria have to be followed to do the valuation. That assumptions has to be taken into. And procedures are adopted in carrying out of valuation. I told you procedures, methodologies. And restriction of use of the report. How I restricted myself of intended user, the same way use of this report also should be. Because my valuation report for not forever. Today that one few companies will take valuation report today and the same report will be used for next 3-4 years. Cannot be. This food is only for now, that's all. I can put in my report, this report is valid for a period of 6 months. Okay. It cannot be used. If you want one more number, you take one more amendment and you do freshly, and based on the circumstances on the particular day, you will calculate. And major factor that will be taken to account during valuation, that has to be made it very clearly. Conclusion, very important. After doing all, what is your final remark, what is your final number, conclusion, that has to be mentioned. And for most, I'll discuss with you, caveats, limitation, disclaimer. It is very, very important. Any report, it may be internal audit report, or forensic report, or transactional audit report, or any sort of report, caveats, limitation, disclaimer, make yourself, restricting yourself and made clarity to the user of the particular report, what exactly it is. So these are the contents, very interestingly, these are the contents. Whether these contents are mandatory or discriminatory, it's a mandatory. That means that is the reason ChatGPT may not give all these points in your report. So that is the reason as an individual challenger, you should know after reading this, you should understand all these contents are mandatorily required to be mentioned in your report. If it's not applicable, not applicable. So that is the reason if all these points put together, if you put in arranging in a systematic scientific way, then you will get a wonderful valuation report. So this is guidance which is issued by the ICAI for members of registered valuers. And so any questions so far? So we'll break. Yeah. So we'll break for a short time for 10-15 minutes. Then I'll request a few members. What are the professional opportunities for registered valuers, for valuers, valuation profession in India, for chartered accountants especially? I repeat, for chartered accountants, what are the professional opportunities in India? Let us see. We'll break for a few minutes. Thank you. Thank you. Welcome back. So, few of members interestingly asked me, all this fine IBC code, all these things, let me understand basic things like who is registered valuers? Probably this could be the starting introduction for me, nevertheless. So, Who is a registered valuer? What is the present scenario if registered valuer in India? How many registered valuers so far in India? If you want to be a registered valuer, what to do? What for? If I done registered valuation professional course, what is the professional opportunity as a registered valuers in India presently? So these are the questions. Another next 20 minutes I'll try to cover it within this time. So valuation profession is not a new profession in India. So being a chartered accountant, from the inception last when chartered accountant was taken, day in day out we used to do valuation in our day-to-day life. We have different type of valuers, true valuers, certified valuers, bankers. If you go land and building, they will say engineers. I am only the valuers. We are the valuers, true valuers, certified valuers. Different organizations are made it themselves as a valuers, entertaining themselves as a valuers, calling them as a valuers. But there is no legal sanctity or legal things. All these things will come only when you have an institutional framework. Thanks to Companies Act 2013 and 18th October 2017, first time in India, the valuation profession was recognized by a legislation called Companies Act. Section 247 is the Companies Act, a single section, one chapter, and within a span of 5 days, the controlling authority is Insolvency and Bankruptcy Board of India is the adjudicating authority. Like our ICAI, how we have controlling authority for the institutional framework. The same way for valuation profession in India is concerned. Insolvency Bankruptcy Board is time being taken as a in charge for this adjudicating authority. And they issued valuation section 247 in the Companies Act. I told you, single section, single chapter. Very simple one, we can read it. And on the same day, they issued a rules also, Companies Registered Valuer and Valuation Rules 2017, which is talking about registered valuer. Who is a registered valuer? Registered valuer is a person who registered with the IBBI after passing the IBBI examination. Registered valuer entity, like partnership firms, how we are doing a profession, the same way two or more registered valuer join together and they can incorporate private limited company also. Whereas our profession is not having it, but LLP as well as private limited company also can be incorporated. That is called registered valuer entity, partnership firm or private limited company. And registered valuer organization, there is a two-tier mechanism of valuation controlling the registered valuers. One is IBBA adjudicating at the supreme level. Next level, RVO, registered valuer organizations. I told you there is about 15 registered valuer organization registered with IBBA. It's like a degree examination. We are registered with Madras University. Under Madras University, there may be hundreds of colleges. And students, anywhere college we can join, but examination conducted by the Madras University. The same way, any RVO, you can be taken the membership and join and taken 15 years of training, but ultimately examination is conducted by the IBBA. It's an online examination, 2 hours examination, multiple choice, 60 marks is a passing, invariably 55, 56, 59, 59.25, 59.5, 59.75, 3-4 times. It is a normal activity, normal, because the quarter mark is a negative mark. It's not so difficult, at the same time it's not so easy examination. Some decent preparation of 50 hours, mandatory training as well as 50 hours homework, definitely required to clear the examination of registered valuer examination. And earlier limitation was given, that also some relaxation recently was given. If you prepare well, definitely you can clear the examination in a scientific way. In May 24, the new syllabus again, time to time we keep on changing the syllabus, but the latest syllabus is May 24 syllabus is presently in place. Examination will be conducted every day in authorized places. I think BSc, Bombay Stock Exchange examination, or NSC. These two people are the places where NSDL. These are two places where examination will be taken, and you have to book a slot at your convenient time, like how cinema tickets we are booking. Book a slot and go for examination and write examination multiple choice, and once you clear, you can register with the IBBI. So that's keeping that background, and we have a valuation standards we discussed, and code of conduct also we discussed. And registered valuer, I told you 247, single section, single chapter. Very simple, very quickly, 247.1 talking about who is the registered valuer and for what purpose they has to do it, who is the appointing authority. So talking about 241 subsection 1 and 2 subsection 2 talking about who is not eligible to do valuation, impartial due diligence and make valuation according to how to do valuation. And finally, what is not, what is default, what is the penalty, and other stuff. That's all. And valuation profession is early 2018, 2018, May somewhere is first batch is started and the first batch student. So far, this is the structure of not much. In the case of, I told you 3 class of assets, land and building, 2,976 members only in India. Plant and machinery, just 567, they are the kids. And in the case of security financial assets, including all put together in India, we have just 2253, as these are the records of IBBI. So not much members are registered. Friends, it's the right time to think about if you want to expand your professional opportunities to the next level, expand your network to the next level. And as I told you, the professional opportunity presently recognized only a couple of three or four legislations presently. That too related to my IBC related things. Only corporate insolvency is invoked now. That is the reason only limited set of cases are on. Just visualize down the line, definitely 1 or 2 years it will be happen. Any time can happen. Even every session, parliament sessions are taking place. When draft Valuer Bill going to transfer as a Valuer Act, we are seeing it. Once Valuer Act is on, as well as these individuals and non-corporates are on, the professional opportunities for traditional practice, if you want to come out, this is the best practice. Valuation, definitely yes.
Sir, who will be competitors to us, like a CA?
The company secretaries and cost accountants and MBAs. They are the people, and compared to them, it's easy for related to few numbers. But compared to cost accountants and company secretaries, definitely yes. I proudly say that chartered accountants, being I trained more than 600 plus qualified registered values out of this 2,200. My students, so like proudly I can say. So definitely chartered accountants are having better edge compared to other two professions. Examination passing also not so difficult if you come across in a scientific way and some sort of format if you understand, and weightages if you understand, and preparation time if you could able to allocate in a such a style, definitely you can crack the examination in first attempt itself, maybe not second time. So it's not so difficult also. So with our limited, your decent experience and knowledge, cracking this examination is probably initially no clue. You took some decent attempts, but now definitely yes, you can easily clear the examinations.
Same person can do all the 3 classes.
If you are qualified for each land and building, qualification will be the engineer BE, B or BTech land and building, civil engineering, and plant and machinery. So if you are an engineer as well as chartered accountant, yes, you can. Yes, there are people out there. You're right. There are engineers as well as chartered accountants out there. MBAs, engineers with MBA. Those people are having 2 qualifications also. Yes. And RVE is nothing but registered value entity, partnership firm or company. Presently we have 115. Required more, further more. And all 3 valuers after multidisciplinary practice is open. Multidisciplinary practice are open, or chartered accountant can be a partner with civil engineers. So your profession is open now. Yes, sir.
So corporate debt under section 247 valuation. Is RB required or practicing CA is enough?
Okay, good. So since sir has asked me, let me take the section very clearly, very quickly, what single section. Where valuation is required to be made in respect of any property, stock, shares, debentures, security or goodwill, or any other assets referred as to assets or net worth of the company. Net worth. Friends, chartered accountants, we are issuing net worth certificate even today also. Net worth certificate, today also, I've seen a lot of net worth certificate issuing by chartered accountants. Net worth or liabilities under the provisions of this act shall be valued by a person having such qualification and experience, registered as a valuer in such manner, as terms as conditions as may be prescribed, and appointed by the audit committee or its absence board of directors of the company. It shall. That means whenever valuation in the section Companies Act, wherever in the Companies Act, more than 12 sections talking about the requirement of the valuation. I'll show you next when things come. In these 12 circumstances, more than 12 circumstances, in Companies Act, wherever valuation is done, it should be done by a qualified registered valuer only. Even though chartered accountant having experience of 50 years, I'm sorry. Because legislation requires a qualification and should be registered with ICAI. Only those people are competent in India legally to sign this valuation of the section Companies Act 2.7. Clear. So that is the reason when we are interested or not interested, passing examination, legally required, you want to be registered, called to be called as a prefix, as a valuer, it is mandatory that should be having it. Friends, this is the cases of Companies Act professional opportunity, more than 12 sections required. For example, section 62(1), further issue of share capital, section 177, terms and offense of audit committee, and 192, very section, we used to get it. Restructuring, power for the compromise arrangements, mergers and acquisition, purchase of minority shareholding, valuation of registered valuer, and all these cases, even more than these apportion mismanagement case, I was fortunate enough to get from Honorable NCLT Court voluntarily. We don't have a panel actually, but my few reports may be at NCLT Court. So when apportion mismanagement cases happen at the court, so finally they will come to both parties, come to conclusion, okay, I'll send the parties and get lost. Then who is the valuer? NCLT Court voluntary appoint me also in few cases as a valuer, and we have a professional opportunity to take it up and do valuation without bias, and do the valuation. These are also mandatory things which required. So all these 13 cases or 14 cases in the companies wherever required, evaluation is required. Only a qualified registered valuer who passed. Who is registered valuer? A registered valuer having a qualification, that is CA/CWCS with 3 years of experience, and who undergone 15 hours training and passed the examination and registered. Who are the competent person to be registered valuer? So only a competent registered valuer only can able to do these valuations. Number 2, in the case of apart from that, the Companies Act, the second legislation which given a shaken hand to the registered valuer profession and recognized is insolvency and bankruptcy code. That's what we discussed. So these are the different more than 7-8 circumstances in the IBC code requirement of a valuation. Whenever required a requirement of valuation, only a qualified registered valuer registered under IBI is the competent authority to do the valuation. This is the second professional opportunity to do the valuation. And of course, after SEBI also few things are required, recognize the importance of valuation. And repeatedly I am telling one particular thing is there is a draft valuer bill in India was framed in 2001 when Corona time, and public opinion is taken and draft was finalized and it went to the parliament. It is sitting in the parliament. Anytime, that's what I told you. In this draft valuer bill once got the assent of the president, it became act, as you know. That became Valuer Act 2025, maybe 24 is gone, 25. Then that is the situation, we will have the professional opportunity as per the Valuers Act. In the Valuers Act, first time in India, there is one wonderful definition, section 2, subsection 52, talking about valuation services. It defined valuation services, first time, what is valuation services? First time given a definition in the legislation. As per the definition, valuation services means the services relating to valuation of assets or liability. A, it's very interesting. A, which is required under the provisions of. That means basically valuation services can be bifurcated into 2 categories. One, which is mandatorily required by the legislation. A, which mandatorily, but because whenever these circumstances are happen in the Companies Act, whenever these type of circumstances happen in the Companies Act, mandatory by legislation required by the registered valuer. B, voluntary also when dispute with the families, dispute with the members, or voluntarily I want to understand where my company was hanging, board want to understand what to do, then they can voluntarily appoint a registered valuers also. So in the definition in the new draft valuer bill talking about 2 subsection 52 that A, which is mandatorily required by the provision, that is mandatory by law. 1A, Banking Regulation Act 1949. Wonderful. So Banking Regulation Act, banks, whenever coming under the bank's preview, whenever required that one, what exactly going to finally draft, going to come, transform as the act, we have to wait and see. Only a qualified register value has to do for Banking Regulation Act. 2. Security Contract Act, all of us knows. 3. Wealth Tax Act. Wealth tax already gone, but still couple of sections, wealth tax registered value was still there, still live under Land and Building Plant Ministry. And whenever you income tax, next post-lunch session we see the importance of the income tax and the registered value are under Income Tax Act and registration process, other stuff. So in Income Tax Act, Security Exchange Board of SEBI required in different circumstances to protect the interests of the shareholders, stakeholders. Valuation required in different circumstances. Whenever required, it should be done by a qualified person. Number 5, security. Number 6, Insurance Regulatory Development Act. Wonderful act actually. IRDA, we have wonderful professional opportunity as a, so even today also, if you can go for miscellaneous value you call, assessor you call, you have to undergo for like some training, and you have to undergo for some test, and very limited number of chartered accountants, number of professionals are available in India, entire India, for but it will be big tickets. It will be big tickets. If you are interested, even today also, before law comes, still it's open. Chartered accountants are competent and eligible to be one of the valuables under IRDA, FEMA, of course. FEMA is a wonderful day in day out. We are also getting in assignments. Being a chartered accountants today, we are getting assignments for FEMA, for inwards or outwards, wherever required, FEMA required, the regulations under the valuation, we have to do the valuation. Security and restructuring financial assets, SIRC Act, simple. SIRC Act, whenever things are DRT is involved, valuation required for the entity. It's also a very good area where a few set of people are only doing presently in the valuation of this area. Prevention of Money Laundering Act. Of late we see Prevention of Money Laundering Act. So this act also we had to undergo for licensing. We had to register. For with the battery is low. So for how you want to do the valuation for this thing required for other people required for registration with the commissionerate. Concern application has to be formed, and only those people are eligible to do it. And Limited Liability Partnership Act, whenever partnership firm was dissolved, when shares are distributed, and conversion, and few set of other sections required under LLP required Partnership Act, required evaluation requirement. Companies Act, which already discussed, LLP. Pension Fund Act, 1 or 2 sections required requirement of the valuation. Black Money Act. Whenever money laundering, black money will follows. Same set of sections, Income Tax Act, same procedure for qualification and application. And IBC code, and interestingly, any other law as may be prescribed. It kept open in future any other law requirement of the valuation, then this particular section will invoke. Explanation for the purpose of this subsection means any act of parliament, legislation, state or any rules, regulations made therein. And B, which arise need of the market as may be specified. That means, in other words, the idea of the registrators is in future, accountant means chartered accountant, valuer means valuer under this Valuer Act. That means unless otherwise we may be having experience as chartered accountant, but still legislation was forced us to undergo for and pass the examination, training, and registered with ICAI presently. And tomorrow, when Valuer bill passed, then new organization going to come, adjudicating authority going to come. That time, all these registered values going to be transformed automatically and going to be valuers then. So, to sum up all these things, these are the more than 16 registrations in India presently requirement of the registered valuers. The beauty of part is each presently, if you want to do a valuation for example, small example, if you take 1 lakh rupee of Indian rupee or 50,000 rupees of Indian rupee, if you want to invest outside India, we require certificate for a company, let's say. We require registration for valuation under FEMA, valuation under Income Tax Act, valuation under Companies Act. Like each, even if it's listed company, valuation under CPE and the concern sections. So each legislation requirement of the valuation separately, and qualification and valuables are separately. It will follow by the Concern Act. So once this draft valuer bill transforms as a valuer act, it's going to be a single act, and it go like IBC code. The same way we are going to have a one legislation for entire valuation function. And as you see in all these 16 legislations, only competent authority is the registered valuer. Friends, so my next speaker also already there. Welcome, sir. So we'll try time to time. That's what I try to say. Now, registered valuers in India is not much, especially coming to our profession 2253 is very, very, very minimal. It's the right time. Think and please join it. And those are already joined, write 1 or 2 attempts and could not able to clear. Don't lose your heart. Definitely take into that. And ICAI RVO recently announced some training sessions for passing the examination. They have undergone training with ICAI RVO. The free of cost you can attend. Even charge also no problem. And kindly spend some decent time, that too November, December, once all legal things are gone, you can at least complete 1 or 2 months. 1 month is quite decent, sufficient. 50 to 60 hours or maximum 70 hours of your preparation homework is quite decent time to complete your examination. So once again, thank you very much for patient listening, and on behalf of Insolvency and Valuation Standard Committee of SIRC ICAI, on behalf of my committee, I thank you very much and wish you all the best, and we'll try to do more seminars like this and try to develop the profession opportunities among the members, and on behalf of my committee and on behalf of all, thank you very much for this wonderful opportunity. Namaste. Any question?
How to get registered for this course?
So first we have to undergo 50 hours of training. So any RVO you have to choose 50 hours training, online coaching or offline, invariably online after post-COVID. So you can undergo online coaching for 50 hours. ICRVO, if you go to the website, ICAI RVO website, if you go, our own RVO, we have it. Other RVO, if you want to go also, at earliest if you want to do, you can, it's up to you. You can complete your 50 hours of training first, then preparation yourself your home, then booking your slot for examination, your convenient time, according to availability, then write the examination, then clear the examination, applying for the IBBI through RVO, your membership, then you can start your practice. Any other questions? Thank you very much for a wonderful time. Thank you very much.
Thank you very much, sir. Thank you for sharing your valuable insight. Thank you, sir. It's my pleasure to introduce Prasanna, sir, to occupy welcome the Prasanna, sir, to occupy the dais. It's my pleasure to introduce Prasanna, sir, as a chartered accountant and a commerce graduate with more than decades of in corporate and international tax and transfer pricing, as extensively advised client on inbound and outbound structuring, holding in jurisdiction and the business model evaluation. He has handling a corporate litigation. He won the FIT fellowship scheme from Foundation of International Tax for 2018 and 2019. He is a regular speaker at ICAI Study Circle and the International Physical Association, and has contributed articles on contemporary issues. He has contributed the book on demystifying Section 194R, published by Tax Tutor along with CTC. Thank you, sir. I request C. Sundar sir to present a short memento to our speaker. And over to the speaker.
Thanks to the SIRC and thanks to the previous speaker to set the context with regard to the valuation opportunities amongst the profession. The scope of this particular section is to look at the valuation aspects from an income tax perspective. There are various sections under which a valuation may be required. So what are all those sections and what are all the intricacies that are surrounding those valuation aspects with regard to each of the sections is the scope for this particular discussion. Now if we look at, we have close to 8 sections or 8 to 9 sections in respect of which a valuation requirement is prescribed under the Income Tax Act. If one were to look at closely, I have not included 5627B, which is one of the most controversial section with regard to the valuation and with regard to litigation surrounding the issue of shares. Why I have not included this? Because the Finance Act number 2 2024 has withdrawn or abolished the angel tax, so-called angel tax provisions with effect from 1st April 2024. So therefore I have not included that particular section as part of this discussion. But as we progress during our discussions, I'll try to highlight what are all the possible issues that has emerged, so that those section is still relevant from a litigation standpoint, although it is abolished on a go-forward basis, but there are still long-standing disputes with regard to issue of shares. Now, one of the important section, if we look at 56.2 subclause 10, this entire section takes care of all other valuation to majority of the extent. So we will look at what is 56.210, and from there on we go about how does the valuation impact, and the scope of this particular discussion is confining only to share and securities. If you look at 56.210 as a such section, it applies to immovable property as well as jewelries, bullion, all other aspects of property. So therefore the discussion will confine only to shares and securities, and if you have any questions or if you have any other views, you can stop me then and there, we can discuss as we move on. Now if you look at the legislative intent behind 56.210, either to 56.2 subsection 5 was there, which was introduced way back in 2010, and then you had 56.2.7b, which were introduced in 2012. These are all more of a situation where there is so much of money laundering keeps happening, and people were circulating the money by infusing capital in various companies. So therefore to carve those kind of money laundering related anti-abuse provisions, 56.2.5 was initially introduced, then you had 56.2.7, 56.2.7a, 56.2.7b. So what in 2018 or rather 2017 the finance bill has done it, they've abolished or they've withdrawn 56.2.5, 56.2.7, 56.2.7a, and all these things have been clubbed together and introduced in the form of 56.2 subclause 10. It is introduced as an anti-abuse measure to deter the practice of converting your black money into a white money by putting into a capital and then dealing with those monies. So therefore what happens, whenever you infuse in a capital or whenever properties are exchanged, is there a scope for undervaluation? Because of this undervaluation, does it result in abuse of income tax? What happens, let's say for example, the fair value of shares is 100 rupees, and if I were to transact it at let's say 50 rupees, then the transaction is maybe a commercially negotiated price. But why will someone sell the shares at 50 when it is valued at 100? So therefore there is a question of shortfall in the valuation of shares. To curb these sort of practices, they brought in some provisions to say whenever, so 56.210 has 3 limbs. One talks about sum of money for without consideration, I am not covering that particular aspect because the scope is valuation of securities. So therefore, I am taking the other two limb. If you receive any shares without a consideration and then the value of shares is more than 50,000, this is one part of it. Or second situation, this is a case where no consideration is involved for you to receive the shares because you have not paid anything, and then the value of shares is more than 50,000. This is on one side of the story. Then the second limb talks about inadequate consideration. While you have paid some consideration, but the consideration is not adequate to the value of property. So how do you then determine what is an inadequate consideration is what been prescribed in the rule. Now if you look at, there is an arbitrary threshold of 50,000. So if the transaction, either the inadequate consideration or nil consideration is only up to 50,000, then this section will not apply. But the moment it crosses 50,000, then there is no basic exemption limit. 50,000 is not a basic exemption limit. The moment your inadequate consideration or nil consideration, the value determined under 56.210 read with rule 11 UA, crosses 50,000, then the entire sum is subject to tax as an income from other sources. While on a hindsight, if you look at, there is no income in a normal sense, but section 56 creates a fiction through which it taxes these sort of deemed gift. Earlier we had a gift tax act which got abolished in 1980s. Now the gift tax and all is reintroduced into income tax in a different form, which is under section 52. So therefore it is only a deeming fiction. Section 224, the income definition, also gives direct linkage to these particular clauses. Now when does this section does not apply? If I received some property in contemplation of death of the holder, receipts under a will or inheritance, receipts from a relative, receipts by a trust or on occasion of marriage and all, it's a rarest circumstances where during a course of marriage someone gives you a property in the form of a shares or securities. But if you look at will or inheritance or receipts from a relative, this is more common in case of a private trust where you want to settle the trust to your relatives, to son, daughter, granddaughter, grandson. So therefore we have to be mindful of the definition of relative. The definition of relative will goes back to section 56 to subsection 5. While you have a relative definition under section 2, but for the purpose of 56, the definition takes you back to section 56 only, 56 subclause to the earlier sections. So therefore there is a slight difference between the definition of relative under section 2 and definitions under 56. So if you fall under any of these category, then there is no question of valuation required. Now if you look at the word property is not defined in 56.210, rather it takes you back to the earlier sections which were repealed, but the definitions has been borrowed. The property in the form of capital asset is the language that has been used. So therefore, if I am receiving the shares from someone else and I have not paid any consideration, the shares worth is, let's say, 1 lakh. If I am accounting this as a capital asset in my books, then 56.210 will trigger. If I am accounting it as stock in trade, then the provisions of 56.210 will not trigger, whereas other sections, let's say for example 194R, do I receive any benefit in the form of a perquisite, those sort of provisions read with 28 subclause 4 will apply. Now for the time being, 56.210, it should be in the form of a capital asset. Then it asks you to refer to 11 UA, which is the valuation procedure prescribed under. Some controversies could come with regard to what do you mean by shares and securities. There is no specific definition of shares and securities under 56.210. Whereas by virtue of powers conferred under section 293, the CBDT has preferred issued a valuation rule in the form of rule 11A. That rule 11 UA There, if you look at Rule 11U, gives you the definition for the section. In that definition, they have defined what do you mean by shares and securities. So therefore, there is a controversy around the powers of the CBDT is only to prescribe the valuation, not to determine what is the scope of shares and securities. But it went on to go and say the shares or securities definition should be taken from Securities Contract Regulation Act. Section 2 subclass H defines what do you mean by securities. There the first limb talks about shares, debentures or any other rights marketable in nature. So therefore the next question comes, only those shares that are marketable in nature is subject to the word securities. What about private companies? Because there is a controversy under Societies Contract Regulation Act whether the shares of the private company could be regarded as a marketable securities or not. While you have some judgments which are in favor stating that it is still a marketable securities, you don't need an actual open market. As long as it is capable of marketing, that is sufficient, is one way of looking at it. But the other way is saying marketable means there has to be a market where buyer and seller should come together to buy the property is one way. If I were to look at, but if you look at 56.210 read with the definition, it uses the word shares and securities. While securities definition go back to SCRA where it talks about marketability, shares there is no definition. So if I were to apply a common meaning which is understandable between two common parties, then the private limited company's shares will fall under the definition of shares, if not in securities. Debentures falls under securities definition. Even rights in securities will fall under securities definition as per SCRA. So therefore, if let's say for example, as a shareholder of a listed entity, today Infosys goes for rights issue of shares. Now as an existing shareholder, I am entitled to subscribe to additional shares. So this is a potential right which I am having on the securities. I can transfer the right to someone else. So this rights in securities is also a security for the purpose of 56.210. So therefore we have to be very mindful of security is a broader definition which includes share warrants, debentures, preference shares, listed or unlisted, everything. Now next question may come, what about interest in partnership firm or interest in LLP? Because securities definition also talks about body corporates. Next question comes, whether the partnership firm is a body corporate. If I were to look at the definition of partnership firm, either under the Income Tax Act or under the Partnership Firm Act, partnership firm is not an incorporated entity. So therefore, it may not fall under the definition of body corporate because it does not have rights and liabilities of a company. It does not have similar rights because partnership firm cannot hold a property. It cannot be legally sued. All the partners will hold the property on behalf of the partnership firm. So therefore, it may not fall under the definition of body corporate. But what about LLP? Because LLP is an incorporated one. It is capable of owning the assets. It is capable of registering the assets in its own name. So therefore, potentially, it may fall under the definition of body corporate because there is also one another provision under the LLP Act which permits you to transfer the LLP interest separately. So therefore, there could be a possibility, but it never been tested under the eyes of law. The next controversy will come, quoted shares or securities, because the valuation, if you look at equity shares, between the equity shares there is a bifurcation between how do you value quoted shares, how do you value unquoted shares, and then how do you value other than equity. So there are three types of valuations that has been prescribed under the Rule 11 UA. So therefore, if you look at the definition of quoted shares as per section 11U, it says means a shares or a security quoted on a recognized stock exchange with regularly from time to time, where the quotation of such shares or securities are based on current transaction made in the ordinary course of business. Now the issue comes, what do you mean by regularity? Regularly, how do I prove? To what extent volume has to be traded in a stock exchange to prove that this particular shares is regularly traded? It's a point of contention, because there could be certain shares, while it may be listed on a stock exchange, but it may not be regularly traded. So how do you then identify regularly traded will be a point of dispute. But if you keep this aside, then we can make a fair assumption that all the listed company shares, assuming for a moment it is regularly traded, we don't have any controversy with regard to regularly traded, it will fall under the definition of quoted shares. As a person, if I invest in, let's say, overseas entities outside India, let's say for example Tesla, and it is listed in a Nasdaq stock exchange, whether this will also be regarded as a quoted shares? The answer is no, because the quoted share definition, if you look at, it talks about recognized stock exchange in India. So therefore, if you have any shares that are listed in outside India, probably it may not fall under the definition of quoted shares. It will still be regarded as a unquoted shares. Now I bifurcated this into 4 buckets. Quoted shares and securities. Let's say for example, if the transaction is carried out through a recognized stock exchange, then for the purpose of 56(2)(10), the transaction value as recognized in the stock exchange will be taken. So therefore that particular value I will compare. Now let's say for example today Infosys is trading at, let's say, 1000 rupees per share, but I have purchased from the stock market, let's say 900. 900 will be is the amount that is recorded for the purpose of transaction in the stock exchange. Then 900 will be taken as a 11 UA value, against which how much have you paid? If I have paid 800, then there is a shortfall of 100. Whether this shortfall of 100, how many shares I have purchased? Let's say for example, if I purchased 10,000 shares, 10,000 shares into 100, this shortfall will come to, let's say, 10 lakhs. Now 10 lakhs is more than this 50,000 limit that has been prescribed under 56(2)(10). So 10 lakhs will be assessed as an income from other sources as deemed gift in my name. While I don't know who has sold the shares in the market, but nevertheless still the charging section treat this as a deemed gift, despite you don't know who is the seller in case of a recognized stock exchange. Now if the quoted shares and securities, if it is transacted outside of the stock exchange, now there is a specific pricing mechanism that has been prescribed. Low prices recorded on any stock exchange as on the valuation date. Valuation date is separately defined under 11 UA. Date immediately preceding the valuation date when such shares or securities are traded. So therefore, the independent transaction which I have carried out with another person outside of market is irrelevant. Before the valuation date, whatever is the lowest prices recorded on the stock exchange, that will determine is there a deemed gift in the case of quoted shares which are transacted outside the stock market. Unquoted equity shares, it doesn't matter whichever mode you transact. Valuation prescribed is adjusted book value method. Say for example, if I take the balance sheet of a particular company, I may own significant properties, I may own significant securities. So what happens in case of property? I may have other assets. So let's put it into 3 buckets. 1, I am holding significant immovable properties. 2nd, I am making investments in other entities. Then 3rd, I have other assets. Say for example, sundry debtors, stock in trade, all that comes in the other bucket. Now with regard to the other bucket, the answer is pretty simple. You take the amount as per the book value. With regard to immovable property, what does it say is, take the stamp duty value or a guideline value applicable to that particular property. That will be substituted. Then with regard to securities, I will still do the same thing. So what happens is, let's say I have 5 investments in 5 companies. So I have to go and value those 5 companies first in the same manner with regard to whether they owns any immovable property, they owns any securities, or they owns any other assets. If it's a service company, pretty simple. You may not have significant changes unless they own some investments in some other entities. Otherwise, it becomes a cumbersome process. So this is one area where the chartered accountant's assistance will come in with regard to valuation of unquoted securities. Other than shares or securities, not covered in any of the other categories. It goes and say, fair market value will be determined based on the open market price as on the valuation date. So that open market price can be valued either by a merchant banker category 1 registered with SEBI or by an accountant. Possible issues. What do you mean by open market value? Because in many instances the word open market value is used. So therefore a question arises whether this open market means there has to be an actual buyer and seller should be there to determine, or is there a price that someone willing to buy that is sufficient, is the point of interpretation, where the courts have said in the past that there need not to be an actual buyer or seller, needs to be in the market. If you, let's say for example, if you go with the particular shares, whatever is the price that someone is willing to purchase, so therefore entire valuation is what? An estimation what would be the price that someone would be willing to buy. So that open market price will have to be adopted for the purpose of this. Valuation date, this is how the definition goes on to say, date on which the property or consideration, as the case may be, is received by the assessee. So therefore, the date of actual consideration paid by you is not relevant, whereas the date on which you receive the property or receives the consideration, whichever is earlier, that will be relevant for the purpose of determining the valuation date. I don't see much of a confusion there with regard to valuation date. The practical difficulty will be with regard to valuation of unquoted shares, because when you have to do a net book value method, there has to be a balance sheet which requires to be drawn. Unfortunately, the rules requires an audited balance sheet. So let's say for example, today if I were to sell a shares, Income Tax Act right with rule requires me to draw the balance sheet date today. Drawing a balance sheet date, at least it's fairly easy task, because I may have a books of accounts, I will prepare the audited balance sheet, but it mandates me to do an audit. Imagine I have some investments in other entities. Now that downstream investments also required to be valued. Let's say for example, if I have only 5% stake in that company, I can't go and demand the company, hey, give me your balance sheet. I have to value my company shares for the purpose of revenue. So therefore these are some issues that could come with regard to valuation. So practically what we do is we go with the management based management based financial accounts for the purpose of valuation.
Any adjustment is allowed for contingent liability?
So contingent liability, there is no adjustment, sir. I will come to it. There is no specific adjustments there. So this adjusted book value is pretty simple sort of an adjustments only they have prescribed. Unless it becomes an actual liability, there is no requirement for you to make an adjustment.
So this is substantial, influence on this financials, cash flow also. And
see, generally what happens whenever I transact in the shares of a company, so the problem is there is no coherence between laws. Various laws prescribes different methodologies. So therefore, it becomes a cost on the company. Say for example, for Companies Act, it mandates whenever you issue a shares, it asks you to get a valuation from a registered valuer. Let's say if you are issuing shares to overseas persons, let's say foreign persons, FEMA accepts either merchant banker or a chartered accountant. Whereas on a company side it says only registered valuer. But for Income Tax Act, earlier section, the 5627B, in case of a DCF, so they had two different methodology for issue of shares. Either you do a DCF or you do a adjusted book value. If someone were to do a DCF value, then it has to be done only by a merchant banker. So even for a resident, it requires a merchant banker. So therefore, for a same issue of shares, you might end up having a multiple valuer certificate. So therefore, we always prescribe whoever is a merchant banker who is also a registered valuer, take a certificate from him so that you satisfy Companies Act, Income Tax Act as well as FEMA, if at all FEMA applies.
No, the thing is, movable property, you take the current fair value. Same fair value, if you apply this also, contingent liability, also some estimate we
See, contingent liability, the general tendency is never hits your books of accounts. It is only outside your books. You show these are all potential liabilities. This entire valuation, if you look at, it is based on adjusted book value. So unless it is sitting in my balance sheet, this is nothing to do with that. But when you do a normal valuation of a company, you have to give regard for a potential liabilities, which will go reduce your fair value of the company. So unfortunately, there is a too much of differences between what is envisaged in this particular methodology vis-a-vis the normal valuation which we do on a company. See, general, if you look at any valuation of a company which is having a going concern, we don't value that company on the basis of a net assets value. We always go by either DCF or market potential or a PE methodology based. Only if the going concern issue is there, people go for a book value based methodology. So therefore, the general transfer of shares valuation you do is totally different from what we do in 11UA. And it's very unlikely that 11UA value is on the higher side compared to what we have under the DCF methodology. In a normal transactions, but when you do a group restructurings, let's say for example, if I want to align a promoter shareholding in a particular company and I do some inter-se transfers between the group entities, that is where this real issue will come. Because when I transact with two independent parties, I don't go and settle for net asset value based consideration. I always see the potential of the company and go with the discounted cash flow. So therefore there is an actual flow of consideration. But when I transact within the group companies, the tendency of the group is always, since I am only realigning the shareholding within the group, ultimately the same person continues to hold the shares. Why will I involve significant cash? Why will I even go for DCF methodology? I might as well go for a lower methodology, which is net book based methodology. So in these sort of group reorganizations or group alignment, this could have a potential impact. So therefore, practically what we do is, when it comes to valuation, we go with the management based certified accounts, do the valuation. Subsequently, you corroborate it with the actuals. Let's say 2 months down the line, is it possible to draw the December numbers? So with December numbers, if I were to look at, there is no significant deviations which what I have done and what has happened in December, possible to justify. There is a one ruling where the court or rather the tribunal has accepted this proposition. If there is not significant deviations between the management accounts and the accounts which are later on audited, then that valuation should be accepted. But the problem is, to what extent the deviations will come in the future when it comes to audited accounts is the key aspect for considerations. One small difference between 56.210 and 56.270 with regard to valuation date. issue of shares related section specifically defines the balance sheet on a different footing compared to what it was. There it provides you an option as on the date of issue of shares, if you can't get your books audited, but go back to the earlier audited which is available. Use that as a base to do the valuation. That sort of flexibility is not there when it comes to 56(2)(10). So therefore, a judgment has to be taken with regard to the management accounts, to what extent the management accounts is fair when it comes to audited balance sheet. So I have to make comparisons that whatever provisions that has to be captured in the books of accounts for the purpose of MIS, I should capture. Whatever is the income tax provisions or income tax refunds that has to be captured, because income tax provision and refund is also one of the adjustments that is required under this particular rule. That has to be captured even in the MIS so that we can do the certification. Some interesting aspects could be, if you look at it, bluntly says net book value method. But when it comes to general valuations, we always look at for what if the shares are subject to a lock-in period, or this is subject to non-transferability related conditions with regard to few years. If these sort of conditions are there, we always give a discount when it comes to a normal valuation. But there are no such provisions that are there under the Income Tax Act. What if the shares are subject to differential voting rights? Act does not discriminate between shares that are subject to differential voting rights versus normal voting rights. Liquidity discount is normal common factors we always give when it comes to value in the private limited companies. But there are no such provisions that are there under the Income Tax Act. So therefore, these sort of some issues could crop up. This is one of the rulings from the Supreme Court in the context of BPL Limited, rendered from a gift tax perspective, the earlier gift tax perspective, where they have said you have to give a liquidity discount to the private limited company's valuation. This particular provisions may come in handy when it comes to commercially negotiated considerations that are agreed between the parties. The other issues are some of the things with regard to Ind AS related aspects. Because interest-free loans given to employees or interest-free loan given to subsidiaries, or for that matter guarantee given to subsidiaries, we do some bit of fair value accounting in the books of accounts. But for the purpose of computing the income, we don't consider the fair value gains or fair value losses with regard to these transactions. But for the purpose of Ind AS, we do recognize these transactions. But how do I treat with 11UA? There is no guidance available. Valuation of compound financial instruments, say for example CCD. A portion of CCD has been treated as an equity, accounted as an equity instruments, and portion of CCD has been treated as a loan based on Ind AS guidances. But how do I give considerations for this? If it is regarded as an equity, then to the extent it will forming part of my shareholders' funds. So therefore, there could possibly be a discrepancy in the valuation between Ind AS company and the accounting standards followed by a particular company. If let's say CCD is there in a company which follows Ind AS and which don't follow Ind AS, there will be a significant difference in the valuation on account of this. What about immovable right of use assets? There is no particular provision. Say for example, I taken a leasehold property for a significant upfront premium I have paid and accounted as a leasehold improvements. Should I go and take the stamp duty value of that particular item for the purpose of valuation? There is no guidance available. Other practical issues could possibly come. What happens in case of a cross-holding? although I agree that Companies Act doesn't permit a cross-holding between holding company and subsidiary company, assume for a moment here the cross-holding is only 10 or 20%. There will be a circular reference, because the rule prescribes me to value all the securities first. That value has to be incorporated in the ultimate entity. So therefore, possibly imagine a situation where you have a chain of holding. Let's say 4 levels of holding is there. As a shareholder of the ultimate holding company, if I want to sell the stake I have in the company, then first I have to value the downstream company and then go for the next level, third level, second level, first level, and then I have to value. So therefore, when it comes to cross-holding, there will be a circular reference, which entity has to be valued first. In case of a chain holding, cumbersome process, because if I am a minority shareholder, I will not be entitled to balance sheet of that particular company. I can't go and enforce, you give me the balance sheet, I have to sell my shares on a particular date. Bullion, of course, has not been prescribed. If an entity were to own a bullion, that bullion value is not being prescribed. Ultimately, when you sell the shares of the company, all the assets has to be valued. Bullion value is not being given. What happens if the company has a negative net worth? Value under 11UA will come negative. But people tend to transact it at fair value. They disregard the negative. Whatever is the fair value of shares will be transacted. So in that case, will the provisions of 56.210 will apply to say that no, you should have taken the money for buying the shares instead of you paying the money. Why did you even pay 10 rupees if the shares of the company is valued minus 10? Ideally, they should have given you money along with the shares. Is it the way I have to look at it? Treatment of preference shares, the rule is silent. If I were to value the equity shares. But practically what we do is we treat the treatment of preference shares as a liability for the purpose of arriving at the value. Otherwise, the value of preference shares will also be included as a part of value of equity. So therefore, to bifurcate this, we treat the value of preference shares as the liability for the purpose of computing the equity shares. Any questions so far?
What about the disputed amount of taxes?
So wherever you have paid taxes, there, if you envisaging any refund, then to the extent you have to make an adjustments for it.
Anything paid under protest?
Yes. It has. So while the rule has not specifically provided, but practically we do an adjustment for income taxes that are paid under the protest.
Gone for an appeal based on the orders?
Fine, it's okay.
No, should we take the liability of the exact amount based on the order?
No, it is based on the books. So the entire valuation is based on the books.
Only 10% of the amount for the purpose of appeal.
Agreed.
Whereas the order says more amount. So should we adjust the entire amount of the tax dues?
To the extent provided in the books of accounts only, you will do an adjustment. So if anything outside the books, it is not permitted. So let's say, for example, in your case, let's say 1 crore is the demand. I would have paid 20% of it as a disputed demand under protest. So the 20% would have been sitting in my assets. So to the extent if I am envisaging any refund, you have to do adjustment for that particular 20. Because there will be a provision sitting on the liability side, asset will be sitting on this. I have to knock off this. And if I am envisaging any refund, then to the extent I have to reduce the value. So if I am envisaging, let's say, a liability is more, I am not envisaging any. So to the extent there will be an addition to my valuation. Deferred tax, it is still silent, but we still do same treatment of income tax, whatever is this. So any contingent liability or any, let's say, any liability that you are envisaging over and above the balance sheet date, if you are not already included in the books of accounts, technically you can't do any adjustments. So if at all you want to see the valuation gets accounted for properly, you have to make entries in the books before drawing the balance sheet date. So this is a smaller section. I'll finish off this and then we break for lunch. Because if you look at 50 CA, it also talks about, it is more from a capital gains perspective in the hands of transferor. Whereas 56.210, if you look at, it is in the hands of a recipient. There is no technical differences between the valuation mechanism under 50 CA versus 56.210. Because all 50 CA says, if your consideration received or accrued as a result of transfer of an unquoted shares. The only difference you see here is, it specifically uses the word unquoted shares. Whereas under 56.210, it specifically says shares and securities, and then the valuation mechanism prescribes quoted shares, unquoted shares, other than unquoted and quoted shares. So therefore everything is covered under the umbrella of 56.210, whereas 50 CA will cover only unquoted shares. If you are selling listed shares, you need not to worry about this. Compare this value with the value determined under 11 UAA. 11 UAA, if you go, it says value as per 11 UA. Again we fall back on the net adjusted book value method. So what happens in a scenario if I gift the shares? There is no consideration. So will 50 CA will come? Possible to argue, because the word used under 50 CA is consideration received or accrued. In case of gift, there is no consideration received, neither accrual, possibly 50 CA may not come. 50B talks about transfer of undertaking, business transfer, basically slump sale. As a, or a slump exchange, because of Finance Act 2020, it also covers slump exchange. As a part of this, if someone were to pay consideration in the form of cash, then this particular provision has no relevance for the purpose of this discussion. But to acquire the business, I am paying partly in cash, partly in shares, then to the extent securities has to be valued. That securities valuation will again fall back on 11 UA. So therefore, that is why I started with saying, if we cover 56.210, then majority of the sections that are prescribing valuation could be addressed. So with this, I'll stop the discussion. Probably we'll break for lunch and we'll continue after lunch. Thank you. Thank you. We will start the discussion from where we left off. So the earlier part of the session we discussed about 56.210, 50 CA and 50 B, where more or less the valuation of securities remains one and the same. Slightly we will move on to transfer pricing and see how this provisions 50 CA, 56.210 and transfer pricing interact, and what are all the issues that could percolate from these interactions. Now if one were to look at what do you mean by transfer pricing, section 92 says any income arising from an international transaction has to be computed having regard to an arm's length price. Arm's length price 92F defines a transaction between two independent parties. So therefore, if a transaction is between associated enterprise has been defined in section 92A, subsection 1 and subsection 2, where more or like a related parties, but not how we look at from an accounting standard perspective or corporate law perspective, or even for that matter section 40A, capital A subsection 2. 92A specifically lists down three parameters. Either I am associated on account of management control, capital control, or a normal control. And they went on to define in which of the ambit these situations may arise. Close to 13 situations they have prescribed where possibly an associate enterprise definition may be created. Now what do you mean by international transaction? International transaction definition is defined in section 92B, where it says that if a transaction as defined in explanation 2, it could be purchase of goods, sale of goods, raw materials, finished goods, services, anything to do with intangibles, securities. Securities part is what we are primarily focused on. If the transaction is between two associate enterprise, either of the associate enterprise is a non-resident, either or both. So therefore, if the transaction has to be with Indian entity and overseas entity, if these two are associate enterprise, if they are transacting in the form of shares or securities, possibly transfer pricing provisions may apply. Another situation could be is if the transaction is between two non-residents but associate enterprise. But if for the seller, this a particular income from transfer of shares is chargeable to tax in India, then possibly there is an income arising in India which may be subject to transfer pricing. So therefore, if you look at 92C, there are about 6 methods that has been prescribed, including the one notified by the CBDT. The first method being comparable uncontrolled method. So I am transacting with an associate enterprise. This is a controlled transaction. There are two unrelated parties entering into similar transaction, which could be possible in case of goods, but may not be possible in the case of shares. It could be an outlier, but we don't know. It may happen or it may not happen. In case of privately owned company, it is hardly a transaction where in the form of shares there will be a third party. While there could be an outlier, but outlier is very minimal. So therefore, comparable uncontrolled price method could not be applied. Resale price method. Technically it will apply I buy and resell, which may not happen in case of shares. So therefore, resale price method may not be applicable. Then you do have three profit-based method, profit split method, which may not be applicable because there it talks about some sort of intangibles presence is required for the purpose of applying profit split method. Then you have cost plus method, which may not apply here as well. Transaction net margin method may not apply here. So the only method that could possibly be applicable is other method, where you are trying to compare something potentially be transactable. If potential transaction is there, what is the price that would have been paid? So therefore, what we generally do is under the other method, we use valuation report. If this particular shares will be sold in an open market, this is the price at which it could fetch. Now if you look at what is that price, how do I arrive at the price? In 56.210 or 50 CA or 50B, there is a specific methodology that has been prescribed, that a net adjusted book value is to be used. But when it comes to this 92C read with the other method, there is no methodology that has been prescribed. So therefore, possible contention could come whether which method should I use. Should I use net asset valuation method, or should I use discounted cash flow method, or any other internationally accepted methods. If you look at Foreign Exchange Management Act, when it comes to issue of shares or transfer of shares, it specifically says that any of the internationally pricing methodology that could be relied to estimate the fair value market of shares. Whereas here, there is no specific indication regarding which method has to be accepted when it comes to valuation. Predominantly, almost in case of a company which is having a going concern, a discounted cash flow methodology or any profit-based methodology is being used for the purpose of valuation. So therefore, using a net asset valuation will have an impact from a transfer pricing. Say for example, if my fair value of shares under DCF method is 100 rupees per share, but my net asset value comes to 30 rupees. So if I were to transact it at 30 rupees, then from a 56.2 point or 50 CA point, I may satisfy the requirement. But from a transfer pricing standpoint, I may not, because judicial precedents, even the Chennai tribunal in the case of Asandas India Private Limited has categorically held, in case of companies which is having a going concern, DCF methodology is an accepted methodology. So therefore, when it comes to international transaction, especially FEMA is also in interplay. So how do I bring some sort of a coherence between all these regulations into picture? FEMA works in two different ways with regard to transactions, be it inbound transaction or is it an outbound transaction. If it's an inbound transaction, the fair market value is a de minimis number. Say for example, if an Indian resident sells the share, assume in the same example, the fair market value is 100. De minimis I have to get 100. I can get 150, 200, not an issue. But de minimis I have to get 100. But whereas, if you look at, if I were to purchase the share, then the fair market value is the maximum outlier that has been fixed. So therefore, depending on inbound or outbound transaction, the de minimis scale or the maximum scale is slightly different. So therefore, when it comes to transfer pricing, it is not appropriate to use a net asset valuation methodology. Now what happens in a scenario where, let's say for example, let's take an example where I am a seller. The fair market value is 100, 50 CA or 50 CA value is, let's say, 50. But the transaction value, let's say, is 30. Now from a 50 CA standpoint, as a transferor, income tax will come and apply what is your actual consideration. Your actual consideration is only 30. Whereas if I value under 11 UA for the purpose of arriving at a capital gain, there is a difference of 20 rupees. I should have at least fetched 50 rupees from a de minimis value. Now this 50 CA itself is a deeming fiction, where if the full value, if the consideration received or accrued as a result of transfer of shares is less than the value as prescribed under 11 UAA, read with 11 UA. This value as per 11 UA now gets replacing the actual consideration. So 30 now becomes 50. But my fair value of shares, assume under transfer pricing is 100. Now can I step up the 50 to 100? Will be a point of dispute, because transfer pricing is also an anti-abuse provision. 50 CA is also an anti-abuse provision. So then how do I look at this particular provision? For a same set of transaction, two different anti-abuse legislations coming into picture. We will take this up in little while. We will park this aside for some time, because 45.3 also have a similar sort of a situation. So therefore, whenever transaction between two associate enterprise, especially an international transaction, transfer pricing is a supreme provisions. So therefore, you should always look at from a DCF methodology whether the transaction value which I have transacted is appropriate from transfer pricing provision standpoint. So therefore, one particular transaction may have significant implications from 50 CA as well as transfer pricing. Imagine the same situation from a recipient point of view, the someone who is buying the shares. Now the consideration actually he has paid is only 30 rupees. But whereas he has got the shares worth of 100, applying a DCF methodology, but applying a net asset valuation methodology, he's got the shares worth of 50. Now from a 56,210 perspective, which is the value that will be adopted for the purpose of taxation? Is it 30 or is it 50 or is it 100? 30 is ignored because 56,210 specifically provides for a mandate that I have to value under net book value methodology. So the moment I apply net book value methodology, 30 is ruled out. Commercially, whatever you have negotiated is not a concern. there is a deemed gift portion. Now there is a deemed gift portion is to the extent of 20 rupees or is it to the extent of 70 rupees. If one were to apply the scale of transfer pricing, there is a deemed gift worth of 70 rupees. Whereas if you look at the section read with the rule, it only talks about 20. So therefore, look at the conundrum. From a 50 CA versus transfer pricing, there could be a possibility transfer pricing will supersede 50 CA value. Whereas same is possible from 56-10 versus transfer pricing, the answer is no. Because 56-10 creates a specific charge based on the specific valuation prescribed under 11U. The moment that has been satisfied, from a recipient standpoint, he may be subject to taxation only to the extent of 20 rupees. It cannot go up to 70. Whereas from a transferor standpoint, it may go up to 70. That is the conundrum which you will have between 56-8, 56-10 and transfer pricing. So if I were to harmoniously interpret, from a 50 CA perspective, if the value of 50 CA is less than transfer pricing value, then transfer pricing value will supersede. Whereas when it comes to 56-10, transfer pricing value may not supersede. But look at a reverse situation. Your value under 11UA is more compared to value under transfer pricing. It is odd, but possible in case of real estate holding entities where your significant stamp duty value of an asset may boost your net book value. So there you will have a different sort of a conundrum. So one has to be very careful when it comes to valuation under DCF vis-a-vis 56-10 versus 50 CA. This interplay is very, very important because especially 50 CA, if you look at, one may wonder why two different value one has to adopt. Same income is getting taxed on a two different persons. If at all in the shortfall which we are talking about 20 rupees between the actual consideration and 11UA value, one transferor is getting hit by 50 CA to the extent of 20. Then under 56-10, recipient of property. So therefore it is two different persons, two different transactions is being envisaged, but the valuation is one. Here the transferor is not getting the actual consideration for it, the property worth. So therefore, under tax of capital gain is trying to get assessed under 50 CA. But when it comes to 56-10, what you are taxing is the recipient of the property because he is getting a deemed gift. The property worth is 50 whereas I am getting it for 30. So therefore the differential 20 is taxable in the hands of recipient as a deemed gift. So therefore this is two different parties, two different transactions. While on the overall perspective we may perceive that this is a single transaction, single income, why it has been taxed twice. But it is not so. Two different parties, two different attack on different sections, different charge. Transfer of capital asset in India. This is more from a indirect transfer. This is one situation where a valuation has an important play. In case of direct transfer, all of us are clear. I own the shares, I am selling it. This is direct transfer. What is this indirect transfer is all about? It all emanated out of the Vodafone India Supreme Court ruling, where the shares of the Cayman Islands company were sold, but the entire value of the Cayman Island company is represented by the Vodafone India. So therefore, what essentially the contention of the department is, you have not sold the shares of Cayman Island, in effect you have sold the shares of Vodafone India. So therefore, if I were to look at Cayman India level, entire value of that overseas entity is representing the value of the Indian entity. So on a standalone basis, Cayman India does not have any value if not for the assets it's own in India. Now look at the situation where you have a foreign company 1, foreign company 2, below that there is an Indian company and the Indian company owns the asset. If foreign company were to sell the transfer of shares of the Indian co, it is taxable in India because what they are selling is the shares of an Indian company. Imagine they go one level above. Foreign co 1 sells the shares of foreign co 2. Ideally, this is a transaction consummating outside India with regard to the foreign company shares. What does India has to do with you is the common question that we may have. But there could be a situation where this FC co derives value substantially from India. So because there is a clear nexus between substantial value that the FC co 2 derives from India, India says, in case if you cross a particular threshold, I want to tax this particular transaction. So it creates a fiction that wherever the value representing the overseas assets by Indian assets exceeds a particular threshold, then India has right to tax it. So therefore by Finance Act 2012, explanation 5, 6, 7 to section 911 was introduced. So as to say, when is the question of indirect transfer is taxable in India? Valuation mechanism has been prescribed under section 9 read with rule 10 UB, wherein they have said, how do I determine the value of foreign company, how do I determine the value of Indian company, and how do I see where Indian value is substantially representing. And there is an attribution of income which is prescribed in rule 10 UC. Explanation 5, if you look at, they want to tax the gain that derives value from the transfer of capital assets, that shares which derives value substantially from asset located in India. Asset located in India has also been described in rule 10 UB, where if let's say for example Indian company has a branch outside India, Indian company has an assets in India but the branch is located outside India, but for the purpose of valuing the Indian company, I should also include the assets located outside India for the purpose of valuation. Explanation 6, if one were to look at, prescribes when does the substantial value is met. If the value of assets located in India is more than 10 crore. If it is less than 10 crore, they don't want to tax all the indirect transfer. They want to transfer, so they want to tax only those assets where the value is much more than 10 crores. Value of Indian assets represents at least 50% of the total assets of the company, which is the foreign company. Let's say for example, if the value of a foreign company is 100 crores, if the value of Indian assets is 40 crores, 10 crore limit is being crossed. But whereas, do I represent at least 50%, 40 divided by 100, and representing only 40%. Indirect transfer provisions may not apply. So therefore there is a de minimis 50% threshold has to be met. This de minimis has to be met on a specified date. Substantial, if you look at 50% which came only in 2015, even before that, based on the Shom Committee report, the Delhi High Court in Kopal research has upheld 50% is constitute substantial. There is also a small shareholders exemption. If your interest in an Indian company is only 5%, then you will be regarded as a small shareholders, then you will not be subject to indirect transfer. Mind you, your holding has to be 5%, not the transfer percentage is 5%. I may have 50%, I may sell 5% on a piecemeal. I will not be entitled for small shareholders exemption. If my holding is only 5% indirectly, then I am entitled for it. Step 1, I have to identify what is the specified date on which I have to do the valuation. That is based on book value of assets, book value of the overseas entity. there are two different dates they are given. Either you do go by valuation date, that is on the date of transfer, or immediate accounting period. Which date I should select? This particular example will give you. Specified date means the last day of the accounting period of the company or entity immediately preceding the date of transfer, or the date of transfer. If the book value of assets of the company or entity on the date of transfer exceeds the book value as on the date of immediately preceding accounting period by 15%. Given, let's look at this illustration. My date of transfer is 24th March 2024. So therefore the immediately preceding accounting period is 31st March 2023. Now if my book value of asset in case 1 is 500 as of 31st March 2023, as on the date of transfer, which is 24th March 2024, it is 525. Is there an increase in book value of assets more than 15%? Answer is no. So therefore in this case, I will take specified date as 31st March 2023. Wherever if the book value between the last accounting period and the date of transfer is exceeding by 15%, then the date of transfer will be the specified date. This is only for the purpose of determining the valuation date, when I should see whether the Indian assets represent at least 50%. To determine this, I have to use the specified date. So what is the specified date? I have to look at from the transaction. Now once this specified date is determined, either it is an accounting period or as on the date of transfer, then I have to value the Indian assets located in India. I also value the foreign company assets, then to see whether I have met 50% or not. Once proportionality test has been satisfied, then income attributable from this transfer is to the extent of this proportion. Say for example, the valuation rule from an Indian entity standpoint, they have bifurcated this into 4 buckets. The bucket 3 and bucket 4 is not relevant for the purpose of this discussion. The purpose of even for that matter, bucket 1. Write-off, in case of write-off management or control is being transferred, then market capitalization based on the observed price on the stock exchange plus book value of liabilities as on the specified date. So this is a one situation where normally we don't add the book value as part of our discounted cash flow method or any of the market pricing methodology. But this is a specific situation where CBDT prescribes you to add the value of liabilities that has been considered for the purpose of valuation, because they want to look at the gross value, not the net worth kind of a computation standpoint. If it's a listed Indian company, other than the above. So therefore, if it does not confer a right of management or control, then market capitalization based on the observable price on the stock exchange. So it is based on the stock exchange value. What happens in the case of an unlisted company? If it's an unlisted company, then valuation is determined by a merchant banker or an accountant as per the internationally accepted methodology. So therefore again a conundrum comes, can I use net asset value? The answer is no if it is a going concern. If it's a going concern, you have to use income based approach to determine this value. Once the value of Indian company has been arrived, now I have to value the foreign company. Foreign company where the transfer is between persons who are not connected persons. If it is between two unrelated parties, then market capitalization basis, full value of consideration, again it asks you to add back the liabilities. If it's a listed foreign company, then the stock exchange price plus the book value of liabilities. If it's an unlisted foreign company, valuation similarly as based on internationally accepted pricing methodology. Now I have the value of Indian company, value of foreign company. Now I go on to test what is the proportion of the Indian company value attributable to the foreign company. Once it touches the limit of 50%, indirect transfer provisions apply. Mind you, this 10 UB is only to determine am I breaching the limit of 50%. It is nothing to do with valuation of shares that you are selling. It is only to determine whether India has a taxing rights or not. So for doing the taxing rights, you have to do a computation to look at am I crossing 50% threshold. India has a right to tax this. The moment this threshold is being applied, then the income from indirect transfer is computed on a normal basis. Because these are all foreign company shares, it is unquoted. Whether it is listed in foreign stock exchange, it doesn't matter. It is still unquoted because the quoted definition under the Income Tax Act is only recognizing stock exchanges in India. If you are listing the shares outside India, it is still an unquoted shares. The moment it becomes unquoted shares, your 50 CA provision, which we have discussed in the earlier discussion, will come into play, which is based on net book value. So therefore, whatever we do in Rule 10 UB, which is based on the internationally accepted methodology, is solely for the purpose of determining the threshold of 50% is breached or not. So that ends about our discussion on indirect transfer. That is why I said most of the computations will go based on the net book value of methodology, the adjusted one. Exception is an indirect transfer where you apply the DCF methodology or other income based methodology solely for the purpose of attributing whether income is taxable in India or not. But the income determination, if you look at, goes back to 50 CA. 45.3 is one section where possibly a valuation methodology may come into play. Assume it's a classic situations where whenever a partnership firm is being floated, a partner may want to contribute the assets into the partnership in lieu of the interest in the partnership. He may contribute immovable property or he may contribute movable property. We are looking at a situation where I, as a shareholder of a particular, let's say Infosys Limited, I want to contribute the shares of the Infosys Limited into the partnership which I am floating. So therefore, you look at, by virtue of section 45.3, capital gains is triggered. Because 45.3 was introduced to overcome Sunil Siddharth Bhai ruling, where they have said whatever amount that is recorded in the books of partnership firm will be the full value consideration. So therefore, if let's say I own 1 lakh shares of Infosys, which is valued at 1 crore, I contributed. If the partnership firm were to record this amount as 2 crores, 2 crores will be the full value consideration for the purpose of computing capital gains. If they were to do a recording of 50 lakhs, now the issue may come, there is a share value which is worth of 1 crore, whereas they have recorded at 50 lakhs. So what happens to this differential? Will 50 CA apply or not? Immediate response is 50 CA should not apply, because 50 CA applies only to unquoted shares. Imagine for a moment, instead of Infosys Limited, same value 1 crore, but it is a private limited company shares, I contribute. He accounts it as 50 lakhs. Now 50 CA can it apply? Will be a question. 45.3 says amount that is recorded in the books of partnership firm will be regarded as a full value consideration, whereas 50 CA, which will apply in case of transfer of shares, says adjusted book value. So therefore, when two provisions merges, two deeming fictions merge, which one should apply? one way of looking at is the later sections which has been introduced should ideally be applicable. In this case, 45.3 was introduced way back in 1980s. 50 CA was introduced only in 2012. So therefore 50 CA will apply because that is later in the sections. The other way of looking at is between the two dealing fiction, which is more general or which is more specific. Whichever is general, that general section should yield to specific section. If you were to look at 45.3, 45.3 introduced specifically to address those transactions which are in nature where a partner is contributing his assets to the partnership firm. So therefore this particular transaction is more specific compared to 50 CA, which will apply only in case of transfer of shares. Between this transfer, both are transfer, but which is more specific? 45.3. So therefore one way of looking at this, 45.3 will apply. So therefore whatever amount that has been recorded in the firm's book, that will alone be regarded as a full value consideration. That amount cannot be more than 50 CA. 50 CA in effect cannot supersedes 45.3 is one way of looking at it. Now another issue will come from the point of firm. Because firm is receiving a property which values 1 crore, but what it records is only 50 lakhs. So is there an inadequate consideration involved when it comes to firm side? 56(2)(10 again will come into play. Now issue will come because firm cannot holds property in its own name, only the partner is holding. Can I make an argument that firm and partner are one and the same? So therefore 56(2)(10 should not apply at all. What if it is an LLP? LLP can hold the property in its own name. So this conundrum will come. Can the firm argues, no, if you look at, in lieu of shares that I have received from the partner, I have given him a partnership interest. There is no provision under the income tax to value this partnership interest. 11 UA does not prescribe any interest. So when do I acquire partnership interest? Partnership is interest acquired at the time of me contributing the assets, or is it acquired over the period of time? See, today the value of firm may be X amount, 50 lakhs. Tomorrow it may become 60 lakhs, 70 lakhs, 80 lakhs. So therefore, whatever interest that I have given, at what point in time I have to value. So therefore, there is a valuation issue which will come when it comes to 45.3. So point of to argue 56(2)(10 may not apply is much more, I would say it is better way of argument that 56(2)(10 may not apply in case of a valuing the partnership interest, because Act does not recognizing partnership interest as a property and there is no valuation mechanisms that has been prescribed. So therefore, how do I say there is an inadequate consideration? Will be a question. 45(4) and 9B, to be precise, whenever a partner's reconstitution happens, there is always potentially some payment has been discharged. The erstwhile 45(4) was revamped with two other sections. You have new 45(4) and section 9B. Section 9B comes to a situation where whenever a specified person, which is a partner, receives any capital asset or stock in trade or both on account of reconstitution or a dissolution, then the amount which I have received in the form of capital asset will be subject to capital gains taxation. This is a classic situation where there could be dual taxation in the hands of firm, because whenever a partner is reconstituted or dissolution, if I am giving a capital asset in the form of shares which is held by the company or which is held by the partnership firm, then section 9B says it is deemed to be a transfer. So therefore, moment it takes the form of transfer, then I have to compute capital gains. Once again, 50 CA will come because it is treating it as a transfer. Computation has to be in accordance with the section 9B, which goes to 48. 45.4 talks about a situation where specified person, that is partners, receives any cash or capital asset or both on account of reconstitution of a specified entity, which is the partnership firm. The only difference between 9B and 45.4 is, if you look at 9B does not cover cash, whereas 45.4 does not cover stock in trade, because 45.4 is a capital gains provision, so therefore it does not cover stock in trade, whereas 9B covers stock in trade but it does not cover cash. One another important point of distinction is both covers reconstitution, but 9B over and above reconstitution covers dissolution. So a single transaction, let's say a partnership, in the partnership firm the partner retires, the firm gives him a capital asset. Both 45.4 will also apply, section 9B will also apply. So this twin taxation for the same transaction is relieved by virtue of 48.3. So but the valuation under 45.4, there is no valuation that has been prescribed. Why? Because it does not, the asset that has been given by the partnership firm to the partner is only regarded as a deemed capital gain. It does not deem it to be a transfer, whereas section 9B deem it to be the transfer. So therefore in 9B there is a possibility 50 CA will apply, whereas under 45.4 possible way of looking at is 50 CA should not apply. Then what value will apply? Open market price under section 2 will be a question, because this is a new provisions. No one has any clarity over the valuation side of it. Valuation of ESOP, which is very more common when it comes to companies nowadays, especially in startups where they are giving employee stock option plan. See, there are various plans that are available, but unfortunately income taxes recognizing only ESOP. If you look at, there is a phantom stocks that has been issued, stock appreciation rights, several forms are there under the practice. But what 1726 is trying to tax is only the value of specified security or sweat equity shares. Only these two instances has been trying to target. What happens to stock appreciation rates or other things will be a different matter of interpretation. For the time being, we will focus only with regard to specified security, because that is a subject matter which has been allotted to us to deliberate upon. So 1726, valuation of any specified security or sweat equity shares allotted or transferred. By these two different aspects are there. Allotment is a situation where company directly allotting the shares to the employees at the time of exercise. Transfer is a situation where possibly the existing shares are being transferred either from a ESOP trust or from a promoter. So this is the two different situations. One, new shares are issued, or situation where existing shares are being transferred. Directly or indirectly. If the company were to use the ESOP trust, then it may fall under the ambit of directly. If they were to allot the shares, it will fall under direct. By the employer or former employer. So don't ever say the moment I exit the organization, after exit I exercise the vested options and I am being allotted shares. You can't say there is no employer-employee relationship. Act clearly says it could be either your present employer or it could be even your past employer. So therefore, in case of vested options, if the exercise of shares have happened after you exiting the employment, still it will be related to salary. What do you mean by specified security? Specified securities means securities as defined in clause 2H of SCRA, and where the employee stock option has been granted under any plan or scheme, includes securities offered under such plan or scheme. Fair market value, rule 3, sub-rule 7 prescribes how do I value when it comes to ESOP. Then options. What do you mean by option? Option is a right but not an obligation granted to an employee to apply for specified security or sweat equity shares at a predetermined price. Whenever a ESOP plan has been decided, initially they will say, okay, you are entitled for 10,000 options. This 10,000 options will vest with you over a period of the vesting period, which could be, let's say for example, 4 years. Then each of the years, so vesting schedule also depends on the scheme. You may have a year end period vesting where all the 10,000 shares could vest at the end of 4 years, or it could have a gradual vesting over a period of 4 years. Depends on the policy of the company. So therefore, the moment they issue options, doesn't mean you are the owner of the securities. You have to satisfy the conditions associated with the options. Generally, they will come with some plan. Okay, you have to, more of a performance evaluation, they will put it as a part of a plan, so that as and when you satisfy those conditions, you are entitled for ESOPs. The moment you are satisfying the conditions, the vesting period is over. So after the vesting period, you are exercise the options. So two interesting aspects when it comes to ESOP is, look at a situation where 1726 talks about the value of specified security or sweat equity shares allotted or transferred directly or indirectly by the employer or former employer, free of cost or a concessional rate. So now I have to arrive what is this concession or a discount price that has been offered to the employee. But when it is taxable at the time of allotment or at the time of transfer. Contrastingly, if I go look at the valuation, for example, you look at the valuation on the right hand side. The value says on the date of exercise, your price is getting freezed. There could be a difference between the date on which you exercise, the date on which the shares are allotted. Let's say for example, today I exercise the shares that are vested on me. After 2 months, shares are getting allotted. The price or the perquisite valuation freezes on the date of exercise, but the taxability arises at the later point on allotment. One interesting aspect one has to be mindful of. When it comes to unlisted shares, it says fair market value on specified date as determined by category 1 SEBI registered merchant banker. So that specified date is nothing but the date of exercise. In case of other securities, fair market value on the date of exercise of the option is such value as determined by SEBI registered category 1 merchant banker. So therefore, accountants have no role if we are not a SEBI registered merchant banker valuation. So therefore, if you want to do valuation here, you have to register yourself as SEBI registered merchant banker. When it comes to equity shares, fair market value is the average opening and closing of shares on the date of exercise. Fair market value is the average opening and closing price of the shares on the date of exercise, which is based on the stock exchange which records more volume. This will apply in a situation where if the stocks are listed in both Bombay Stock Exchange as well as National Stock Exchange, whichever is more, you have to take it. In case of no trading on such shares, as the fair market value will be on closing price on date closest to the date of exercise and immediately preceding the date. or closing price on the date closest to the date of exercise and immediately preceding the date. When the shares are listed on two stock exchanges, neither of the stock exchange has significant volume, then whichever is records more volume between these two, I will take the closing price. One difference between the first two bullets and the next two bullets is, first two bullet, if you look at, you are looking at average of opening and closing. But when it comes to the second or rather third and fourth bullets, if you look at, you are taking only the closing price. So this is difference between the stocks which are traded more, stocks which are not traded. Depending on that, your valuation may undergo a change. But the valuation is on the date of exercise, but the taxability is on the date of allotment. So therefore, there could be potentially a timing gap between your exercise and allotment. During that period, if there is any increase in value of shares, that incremental value may not be subject to taxation. So your valuation freezes on the date of exercise. Coming to the last leg of our discussion, this is a situation where income computational disclosure standards which prescribes valuation with regard to securities that are kept as a stock in trade. Security definition once again takes back you to SCRI regulations. Fair value has been described to say amount for which an asset could be exchanged between a knowledgeable buyer and seller in an arm's length transaction. Arm's length transaction, the language used here need not sync with your section 92, which deals with arm's length price. So therefore, what could be an arm's length transaction? One has to ponder upon. And what do they mean knowledgeable buyer and seller? We'll never know. But nevertheless, you have valuation methodology through which you can arrive at a price, which could be an arm's length transaction if two buyer and seller is interacting to purchase the shares. The classification of securities is divided into shares, debt security, convertible security, and others. If you look at, there is no distinction between equity and preference. Both will come under shares, unless you say CC, it will fall under convertible securities. Convertible securities may have CCDs. Debt securities may have optionally convertible or normal debentures which are redeemable, and others could be unit of mutual funds, all that. I have to make a comparison of actual cost initially recognized and net realizable value. That would be based on category wise, not for each individual class. Say for example, if I were to compute capital gains, then for each equity shares I will compute capital gains. Say for example, I hold 10 investments. 10 investments will be independently computed, period of holding will be drawn, so that I will classify what is long term, what is short term, and then I will compute capital gain. Whereas here, if you look at, the valuation is based on the categories: shares, securities, between that security, debt, convertible, and others. If you look at accounting standards, the valuation will be based on each class of shares, cost or NRV, whichever is lower. Whereas if you look at here, I will do a bucket approach. By bucket approach, let's say for example, the cost of acquisition is in column 2. Infosys shares I bought for 12 lakhs. ITC shares I bought for 5 lakh. TCS shares I bought for 10 lakhs. Now my total value of shares is 27 lakhs. Contradistinguishingly, if you look at the NRV, Infosys is 11 lakh, ITC is 6 lakhs, TCS is 9 lakhs. So the total comes up to 26 lakhs. Now if I were to look at this valuation from accounting standard point of view, each class of share, Infosys, I will look at cost or NRV, whichever is lower. ITC, likewise, I will look at cost or NRV, whichever is lower. TCS, cost of NRV, whichever is lower. If you look at, my book value could be possibly 25 lakhs. from an accounting standard point of view if I apply AS 13. Contradictingly, ICDA says nothing doing, don't go by accounting standards. I have my own standards. Follow the category wise. You fall under the category of shares. So therefore, whatever is the total value of shares, vis-a-vis total NRV, between the two, whichever is lower, I will take it. So in this example, under ICDS, I may end up at the value of 26 lakhs, whereas under accounting standards, you may end up at the value of 25 lakhs. So to this extent, there could be a disallowance or computational adjustments which are required to be made between ICDS and accounting standards. Initial recognition, like I said, it is based on the cost. Cost could be purchase price, acquisition charges, it could be brokerage fee, whatever charges that you are paid, including duty and cess. Security transaction tax may not be included as a part of cost because that is never fall under the definition of acquisition charges. Can also refer to the institute guidance on ICDS implementation. Another distinction that could come between ICDS and accounting standard is when the assets are exchanged. Ideally, accounting standard prescribes that the asset that you have given up, that value has to be recorded as a value for the incoming assets. So the value of outgoing assets will be the value for incoming assets. Only in exceptional situation where the value of outgoing assets is not there, you will record the value of incoming assets. Whereas under ICDS, it says if the asset is acquired through exchange of security, I have one security, Infosys shares. I give up Infosys shares and take TCS shares. I have to record the value of TCS shares, not the value of Infosys shares. Likewise, acquired assets through exchange of any other assets. If I exchange any other assets, say for example, I give up land and get securities. The value of securities has to be recorded. Subsequent measurements, if you look at unquoted or thinly traded listed securities, it should be based on actual cost. In case of other securities, it is lower of NRV versus initial cost that is recognized at the year end. Inventory being held by scheduled banks or public financial institutions will follow RBI guidelines. Unfortunately, there is no clarification whether NBFC will also be recognized for the purpose of this standard. So therefore, NBFC are put in a limbo whether they will follow ICDS or they have to follow RBI guidelines. As far as the current provisions stand, NBFC has to follow ICDS. So this is just a summary of various regulations, not only income tax, where what and all nature of transactions under different regulations, what are all the methodology that has been proposed, and who is required to value these shares. If you look at under Companies Act, if the one were to do a preferential issue for unlisted companies under section 42 or 62, any internationally accepted methodology, but the valuer is registered valuer. Same thing for Companies Act, for the purpose of merger, demerger or a compromise, internationally accepted methodology, valuer is registered. From a FEMA standpoint, whether you're doing FDI, ODI or transfer between resident and non-residents. Listed shares, obviously we will follow SEBI guidelines, whereas when it comes to unlisted shares, it is internationally accepted methodology, that too by a merchant banker or a chartered accountant. SEBI takeover regulations, depending on direct acquisition or indirect acquisition, either it's a merchant banker or a registered valuer. Preferential issue, likewise, frequently traded or not frequently traded, merchant banker or a registered valuer. When it comes to Income Tax Act, we have a mix between merchant banker and accountant. Merchant banker will come when it comes to open market value for other securities other than equity, whereas in case of equity, you do have an accountant. Valuation is prescribed. This, if you look at, there is no coherence across these laws. Each law talks about different methodology, different valuers. So therefore, hopefully they will come with some sort of a coherence, so that significant costs that are involved in obtaining all these certification is being addressed. With this, I'll close my discussion. I'll open for any questions, if at all anything is still there. I've already shared the slides with the institute. Probably they will circulate it either in the website or to the mail IDs. Any questions, sir? No questions. Thank you. Thanks to the SIRC for giving me this opportunity. Thank you.
The presentation is visible. So thanks to ICAI SIRC chapter for inviting me for this session. I'm glad to meet you all, and I would be covering the topic valuation for mergers and acquisitions. I just went through the topics discussed in the previous session, and few of the slides which I wanted to cover is already covered, and it's good that it will just be a quick walkthrough on those particular topics, and I'll try to delve more into the mergers and acquisitions portion. So session objectives primarily would be just to understand first of all the basic concepts on mergers and acquisition, the valuation requirements in merger and acquisitions like regulatory, financial reporting and whatever the regulations are. We'll touch upon the valuation methodologies, and also I mean just from my practical experience, what are the key considerations in performing valuations for mergers and acquisitions. These are certain things which we'll try to cover in this particular session. So first of all, I would like to show this chart. I mean, if you look at this chart, what you will see is that the valuation is required in the entire life cycle of a transaction. So if you look at whenever you do a merger and acquisition, I think the first phase is actually like a target identification. So whenever you are doing a target identification, at that point you would like to know what is the, I mean, what is my appetite or what is the appetite for me to pay, right? So for that you need to also know what is the price someone is expecting. So an entry valuation is something which might be something someone will think of at the time when they are trying to identify a transaction. Then if you look at negotiation and term sheet, so when you move a little ahead in transaction, you would like to sign a term sheet. At the time of signing a term sheet also you want to have some sense on the value of the company. So at that point of time also someone would like to use a valuer so that they can give a precise, say maybe a good range of value at which they might be ready to enter a deal. Once they move ahead with the diligence process and then once the company is acquired, post-acquisition also there are certain valuation requirements which might come, like say from a financial reporting point of view, like purchase price allocation. Once a company acquires another company, they will have to report what have they paid for, like the consideration, intangible assets, tangible assets and remaining going into goodwill. So at that point of time also you need a valuation. Then if the company in subsequent years goes for say internal restructuring, which might be for various reasons, there may be merger, there may be demerger, so at that point of time also you need a valuation. Say in case the company goes in for expansion and they need funding, again there might be a valuation requirement. If in case the transaction was say a joint venture and someone wants to get out of that particular company, so again valuation may be required from say an exit point of view, whether it might be from the company which is acquiring or the minority shareholder who are exiting, they might appoint a valuation. So basically what I'm trying to highlight is that if you look at this entire transaction life cycle, valuation starts pre-transaction, and even when the transaction closes, valuation is required. And post-transaction closure also, there is a requirement of valuation. So valuation is very critical in the entire transaction life cycle and even in the cycle of the company whenever, I mean, in their operations of the company. So, coming to basic concept of merger and acquisition. So what is a merger? I mean, company A, company B, okay? Both of them come together and they merge. Now, when they merge, there will be one company which will survive. Either it will be company A or company B. One company will lose its identity, okay? And then generally what happens in a merger, I mean, this company A has certain shareholders, company B has certain shareholders. When they merge, now the shareholders of, say, the result, one will be a transferor company, the company which will lose its identity, and the other is a transferee company. So whichever company survives, that company's shares will be issued to the other company, which will not be surviving, to the shareholders of that company. So in this case, say A plus B, and A is the surviving entity. So the shareholders of B will get the shares of A. So what will remain after the merger is only company A, and the shareholders of A and B both will be having shares of company A. Okay, and that is generally done through swap ratio. We'll be covering it in more details. And then shareholders of merging entities continue to hold shares post-merger. Second thing is acquisition. What happens in acquisition? You identify a certain entity, then you acquire that company. So the difference between, say, merger and acquisition is, one is, in merger, one of the entity will be losing its identity. Okay. In acquisition, what happens is that the entity will continue. You acquire one company, that kind of company might become your subsidiary. In case you are acquiring 100% stake, it might become a wholly owned subsidiary, or it might be a subsidiary, or it might be an investment, depending on what is the stake you are acquiring. Generally, acquisition happens through cash, but even through share exchange, but mostly it's through cash. While merger, it's mostly through share exchange ratio only. There is no consideration which is paid, because the moment consideration is paid, it will be like a acquisition only. So one critical question which comes into mind is that why will someone go for a merger, and why will someone go for an acquisition? What is the objective? The objective is simple. I mean, based on the difference, you can point out, right? One entity loses identity. The shareholders of that entity doesn't get anything, doesn't stay back. Like in acquisition, the shareholders of that company doesn't stay back if you're acquiring the entire company, right? So you are acquiring one company because you are acquiring that company because you know that there are certain diversification strategy or other strategy because of which you are acquired, and you don't want that shareholder to continue. You know you can run that company better. So in case you don't want someone else to be running that company, you generally go in for acquisition, leave those other shareholders out, and you have the total control. While the merger, they will also have, based on the stock issuance or the share swap ratio, the previous shareholders will continue. So depending on what is your strategy, whether you want to run it or you want the other shareholders also to continue. Both the companies sharing the growth going forward, depending on that. Other thing could be, from a very important point, would be from a tax angle point of view. Generally what happens is mergers are considered tax neutral. So there is no tax implication as such when the share exchanges are happening. And also, if there are carry forward losses, say company A is merging with company B, and company B has a huge losses, okay? What they can do is that when they're merging, the tax losses can still continue and be offset, okay, by the profitable company and non-profitable company. They both merge. So from a tax optimization point of view, it helps. But if you look at acquisition, in acquisition, you may or may not be able to take the benefit of tax losses, depending on how you are structuring the transaction. Like when you are doing a acquisition of shares, like in this case, the chart which I have presented you, B continues to be a wholly owned subsidiary or whatever subsidiary, a separate entity. Then in that case, they will be able to use the tax losses whichever is there in the books. But say in case it is done through a asset purchase agreement, there is no legal entity left. So you may not be able to use the tax losses. So that's the reason, you'll have to look at why someone might want to do a merger, why someone would want to do an acquisition. Because in acquisition, there would be capital gain tax because someone is selling the share, so there are tax implications. And whoever is the shareholder, they may completely exit out of the business. So, there is no upside which they might have as part of acquisition. But in case of a merger, they both can, as a combined entity, move forward. So, as I was telling you, why do companies carry out merger and acquisition? Undervaluation. Typically, most of the financial investors, they look to try to find out which is the company which is undervalued or has a huge potential. They will try to enter into that market. There are two types of investors. One is financial investor, another is strategic investor. Strategic investors are someone who are in that business and want to acquire another company. Why? Because they may have an operational synergy. Okay, operational synergy means like what you would have heard, operating cost, right? operating synergy, which will be more like a fixed cost, variable cost. And then there are financial synergies wherein you know that, okay, one company has more debt, another company is less leveraged. Then you would like to do that acquisition or merger to enjoy the financial synergy benefit. Diversification, like if you look at Quicker Common Flow or Tata Air India, it's more of diversification. So many companies do the acquisition because of that reason also. Others could be like killing competition. You don't want, like Myntra Jabong. Jabong was acquired, Jabong was growing up fast, but Myntra just came and acquired Jabong, and now you see it's only Myntra, right? So sometimes you even acquire, I mean, old case would be even say Coca-Cola acquiring say Thumbs Up and the other Gold Spot brand which we had. So I think it's more to do with killing competition. So there could be various reasons why companies want to do basically an acquisition or merger. Seller's reason could be they want to get out of the business, it's distressed, or it's a non-core business. Many times when it's non-core, they would like to demerge only that particular undertaking and sell it. Not able to scale because of funding issues, or say the promoters of that company are someone who are at the high end of their retirement age. They might just like to say exit the market. So if they are getting good price, they would just get out of that business. Lack of capital, as I said, it might be just related to distress, not able to raise the new round of funding. And in case they come under the ambit of a larger company who are able to raise the fund, the company might succeed, so they might want to exit. So types of mergers, I mean, I have just put some illustrative cases just to show you how the mergers can be. Like there could be company A and company B. And both have independent shareholders. So both of them merging, you would require a valuation to be done of company A as well as company B. And depending on say value per share of company A, company B, you will determine the share exchange ratio. When I tell share exchange ratio, basically it means that say company A fair value. Whenever I'm talking about the per share value, it will be more of fair value per share. So company A's share is say worth 100 rupees based on fair valuation, and company B's share is worth say 50 rupees per share. So now when both the companies are merging and only company A is surviving, then what will happen is that company B's share is worth 50. So if they are giving the entire company to them, they will need to know that the exchange ratio may be say 150. So for every 2 shares of company B, they will get 1 share of company A. So that is how the share exchange ratio is determined, based on the relative value of each of the company's shares. Okay, because company B will not survive, only company A will be left. So how much shares should be issued to shareholders of company B? So example would be here, say Vodafone Idea, Flipkart, eBay, PVR, Inox. So in these cases, what happened is that they determined the value of both, say PVR as well as Inox, and then per share value of PVR, per share value of Inox. And when they look at what is the exchange ratio, exchange ratio is nothing but dividing the share of each of the company and coming to a rounded number. Generally that in case, I mean it was simple 50 and 100, it was like 2 in simple case. But it could be like 17 and say 18. Then you can't divide 18 and 17 and say that okay, 1.17 per share, because shares are issued in full numbers. So you might have to multiply and say 170 shares and 180 shares. For every 180 shares, you might get 170 shares. So something like that, you will have to do a computation. But that's how the ratio is determined. Another would be say merger of a listed company with unlisted company. So one company is listed, another may be unlisted. In this case also, you will determine the share swap ratio. You have to value both the company and determine the share swap ratio and do it. Merger with a foreign company. This was earlier not allowed. I mean, it was laid down, but it was very difficult. But now I think recently they have come up with some modification, and they are working on some guideline wherein even merger between an Indian entity and a foreign entity is possible, subject to certain approvals from RBI. So this is a very welcome move which has just recently come. Fourth would be say merger of a wholly owned subsidiary into its holding company. So if there is a holding company and the wholly owned subsidiary merges into a holding company, do you need to do valuation? I don't think so, because the shareholders are the same, the ultimate shareholders. So when there is no change in the resultant shareholding structure of a company, you don't need to do valuation. In this case, it will not go through NCLT, nothing. I mean, valuation is not required because it's the same shareholder. You will issue the shares of the existing company again to the new existing shareholder. It doesn't make sense. So in this case, no valuation is required. Next is demerger. So merger, as I explained to you, A plus B, and then both of them merge, A or B, one of them is surviving. What is demerger? Demerger means company A has, say, certain business or business undertaking. They just want to demerge it, and that will merge into, say, another company. So in this case, I mean, what could be the reason for demerger? One is that, like, non-core business. I don't know, I want to just hive off that business. Then in that case, you might go for a demerger. Okay, because mostly to do with, say, undertaking, or a company has certain, say, subsidiaries which they don't want to keep. They will just demerge it and give it to another company. In this case also, again, a valuation would be required based on share swap ratio. Like if you look at HCL Tech, Geometric Solution. So in this case, what happened is that you determine company A's value, which is the demerging company value, not the entire company value. Only the portion which you are trying to demerge. Just value that. Again, calculate the per share value and the entity in which it is getting demerged. So there also you try to value that and then calculate the share exchange ratio. Okay. So here what will happen is company A, which is demerging it, the shareholders of that company will get the shares of company B because that is the entity which is acquiring. It's kind of an acquisition of a portion where the consideration is being paid through shares instead of being paid through cash. Demerger of an undertaking into a new company with the same shareholding. If company A is a holding company and they are demerging one of their portion of one of the undertaking into a new company, okay. So in case they are keeping the shareholding same, I mean company A has, say, undertaking which they are moving to, say, company B, and both the shareholders are same. In this case also you don't need to do a valuation because it's like a mirror image. So no valuation is required in this case. Whenever there is a merger, the share swap is called a share exchange ratio. When there is a demerger, it is called share entitlement ratio. Because in merger, both the companies are exchanging shares of each other, right? I mean, one of the companies. But in what is happening in demerger is that the shares of the company to which the transfer is happening, they issue their shares. So it is called a share entitlement ratio. I mean, the concept is same, it's more to do with the wording, how it's mentioned. Merger, demerger, valuation, general proposition, like in any valuation, you do a fair valuation, but one thing which is very different in merger or demerger is relative value. Okay. What fair value means is what it would fetch in the open market or anything. Okay, say if the fair valuation of company A is 100, fair valuation of company B is 50, okay, the ratio is 2:1, right? But what merger valuation says is that you should do a relative valuation. So even if, say, you are doing company A, you are valuing it as, say, instead of 100 as, say, 50, and you are valuing company B as 25, it doesn't matter because this exchange ratio still remains same at as 2:1 only, okay? So merger demerger valuation is more like a relative valuation rather than a fair valuation, because the important thing here is that the guideline says that you should try to use as many methodologies as possible and relevant. Okay, so like even if I am doing a company valuation wherein the company is to be valued on a going concern basis, I might give weight to both the methods, say even DCF and market multiple method. But the important thing is that I'll have to give weights to methods in both the cases. Like I can't do that company A will be valued based on DCF, company B will be valued in NAV. That cannot be done. If you're using certain methodologies, it has to be consistent. You have to use in both the company's case, and the weights also should be the same. So in case you're not doing it, SEBI clearly mentions that you have to justify why you are not using it. Like in some cases, say if there is a one-side company which is a listed company, you can use a market price method. But in company B, you can't use. So you can justify that why you have not used a market price method. But in other cases, you can't use different methods or use different weights. That it has to be consistent. And that's why what they say is it's called a relative valuation rather than a fair valuation. Then for listed companies, whether, I mean, I think I have covered a couple of points already in my discussion. I'm just seeing if I have missed out on anything. But yeah, I think one point is that synergies should not be taken into account when you are doing the valuation for mergers. And then there are certain valuation judgments which are there, which are a good read in case someone wants to read. I mean, there is HLL Union versus Hindustan Lever case, which actually describes in more details why assigning weights to different methodologies. This is a court case where the different methodologies have been used to determine the exchange ratio. Then there is another case of Mafatlal, wherein they say that whatever the share exchange ratio is determined, generally not disturbed by court unless objected and grossly unfair. This is how the the share exchange ratio report looks like. The report is quite detailed, but this is just the summary of how the fair exchange ratio looks like. So if you look at XYZ Limited, PQR Limited, you calculate the value per share under various approaches, give them weight. But as I told you, that the weight has to be considered consistent. If you are giving 50% weight to income approach, then it has to be 50% weight in both the companies. Similarly, market approach, if you are giving, say, remaining 50%, it has to be consistent. Then you arrive at what is the relative value per share, and then based on the division, you will come to exchange ratio. So this is something which SEBI has prescribed, and if you go to SEBI website and try to download the old, say, merger demerger report and all, you will be able to see this format, this prescribed format. On all the valuation, you will see that this is something which they will have to capture in their report. So after touching upon merger, the next, I will be covering more on valuation methodology and all, but just type of acquisition, it could be, say, based on geography, like domestic acquisition or cross-border acquisition, based on structure, whether it's a share purchase agreement or asset purchase agreement. Share purchase agreement, when you acquire the entire shares of a company, it's called a share purchase. And then there are other ways of acquiring a company wherein you are not acquiring the entire shares of a company, but only, say, certain assets of that company. So it's called an asset purchase or a business transfer agreement. Those are the kind of documents which are signed. Then based on stake acquired, if you're acquiring 100% stake, subsidiary, more than 50% controlling, less than 50% investment. 50% is just a number I had taken, assuming that control comes because of 50%. It may or may not come also, based on the board seat and all. Then there is something called creeping acquisition. Creeping acquisition is more to do with, like, you already hold, say, 30% stake, and then you acquire another 25%. So it's like, it's again called a controlling stake acquisition. So, based on what stake you are acquiring, accounting changes. So one has to be careful when you are talking about acquisition. There are various regulations and accounting implications based on how you are, what you are acquiring, how much you are acquiring. Since most of you are here a CA, you would know that what is done in case of, say, investment, what is done in case you are doing a full acquisition. Like purchase price allocation will only kick in case you have a controlling stake. Then you might have to do a purchase price allocation. But if they are like an investment, you might just check for fair valuation whether it has gone below or not. And if it's held for sale, then you'll have to do mark to market. So it depends on the type of acquisition you might be doing. So valuation requirements in an M&A, regulatory and others. I think regulatory portion, a lot of thing was covered from a tax point of view and SEBI regulation point of view. So I don't think I need to touch upon much, but I'll just explain like what are the requirements of valuation when someone is going for a merger and acquisition. Internal purpose, whenever you're going for a transaction, you will have to convince the shareholders, the board. So you might need a valuation just to show it to the board that, okay, this is the fair value of the company and we want to invest in that, so that you have an approval. Or you might need for negotiation. Okay, it might be from a seller side or the acquirer side. They might want to have a report just to negotiate better. Or it might be even for value discovery. Like, I mean, someone wants to sell the company, but he has no clue. I mean, what is the value of my company? So in that case also, it might be more of a price discovery. Companies Act, Section 232 to 232, that deals with merger and amalgamation of companies, wherein the valuation has to be done by a registered valuer. And also fairness opinion is required. In case the listed companies are involved, then you need a fairness opinion also to be done by a merchant banker. But the methodology remains the same, whatever I explained you on the standard approach of asset, market, and asset approach, market approach, and income approach. I will be covering those approaches more in details, but basically doing a relative valuation. Then Section 236 deals with minority shareholding purchase. Whenever you are doing a merger and acquisition, though you might be doing under, say, Companies Act, but you cannot look at one regulation in isolation. You will also have to keep in mind other regulations also if that has an impact. Like SEBI ICDR regulations is important, SEBI SAST regulations is important. I don't know if SEBI SAST regulations was covered or not, but just briefly telling that in case, say, some transaction happens outside, I mean, in case there is a transaction which happens and say more than, say it's a direct acquisition, then you will have to, of a certain percentage, you will have to also make an open offer, basically, as per SEBI SAST guidelines. If you are acquiring more than, say, 25%, or if you already have a 25% and if you are acquiring more by, say, 5%, I think that is the criteria, then you will have to make an open offer. And whenever you are making an open offer, there are certain guidelines on what is the open offer price which you will have to pay. So ICDR is more to do with the open offer price. There could be acquisition in terms of direct acquisition, or it could be indirect acquisition. The company is in India, the listed company is in India, and there is a parent company, say, outside India that got acquired, and most of the revenue, say 80% of the net asset, or there are certain parameters mentioned. If those are being met, it will be called deemed as a direct acquisition. And again, there are various ways to look at how the open offer price should be. SEBI ICDR regulations, basically issue of capital. So even if you have determined, say, relative value of companies, but it cannot go lesser than, say, 60-day volume weighted average market price or 30-day volume weighted average market price. So that has to be kept in mind when you're doing any merger, demerger, as per SEBI regulations. Income Tax Act, just to keep in mind, because I mean, whenever the transaction happens, the buyer or seller wants to optimize tax. So they will have to keep in mind what would be the implication from tax point of view. 50 CA, I think, was fairly covered by the previous speaker. And then 56.210 also is something which he had covered. Indirect transfer of shares, whenever there is a transaction outside India and India is deriving the major portion of the value of the company, you will have to keep in mind that indirect transfer of shares will kick in. FEMA regulations, this is more to do with when you are making an acquisition or someone is making an acquisition in India. That has to be compliant with foreign exchange FDI rules in India. So to make it very simple, what FDI rule says is that you have to follow the pricing guidelines. Okay, money is coming into India, so Indian government doesn't want that someone outside India, if they are getting any share of this company, that should not be less than the fair value. If they pay more than that, I am fine, but they cannot pay less than that. Okay. Similarly, when I am selling the, I am acquiring the shares from someone else, it will be opposite. That it should not be higher than that. Okay. So that is the pricing guideline you will have to follow whenever there is a foreign investment in India. So that the money which is coming into it, India should not be less. But money which is going outside India to, say, a non-resident, it can be lower, they are fine with it. And pricing guideline generally says that if it's a listed company, then I think it's simple. But if it's non-listed, then you will have to use a generally accepted valuation methodologies, which is nothing but the income, market, asset approach, whichever is relevant. Financial reporting, once the merger and acquisition or transaction happens, mostly in case of acquisition rather than mergers, whenever the acquisition is done, then even in merger, in case you are doing, there are two ways of accounting merger. Whether pooling of interest method or purchase method. In case it's a purchase method, then purchase price allocation will be applicable. Pooling of interest, it's not required. But in case of all acquisitions where you are getting a control, you will have to do a purchase price allocation, or you will have to do fair valuation of investment instruments. And 1 year down the line, when goodwill is already reported, then annual reporting period, you will have to do an impairment testing of the goodwill which is sitting in the books, or any intangible assets if there are indefinitely lived intangible assets. You might have to do all those valuations. So here what I was just trying to cover is that in an M&A cycle, under various regulations, you might end up doing valuation of the companies or investments. Coming to valuation methodologies, we'll have to see first of all what are we trying to value, whether we are trying to value a business or an equity. Because even in a transaction, whether you're acquiring a company debt-free or you're acquiring with debt, depending on what you're acquiring, you will have to value accordingly. Like if you're taking over debt, you might as well pay them the equity value. If you're acquiring net of debt, you might pay them enterprise value, but if you're acquiring with debt, you might like to value the equity shares of the company. So the methodologies, I think for valuation again remains the broad 3 valuation methodologies. One is the income approach, which is more used for companies as a going concern, which has a good potential. So generally this represents the income generating capability of the company and is the most preferred method, which is the discounted cash flow approach. Earning capitalization is nothing but a form of an income approach where you just capitalize the earning. Market approach, you have market price in case the company is listed, but in case the company is not listed, other market price method would be that you look at companies in similar space which are listed. Now those could be fairly comparable to that company in the same geography, same industry, similar size. Try to find out companies which are as close as possible to my company and try to value it. Comparable transaction multiple, you look at transaction in the space. If transactions have happened, try to look at the multiples at which the transactions have happened and apply those multiples to your own companies. I'll cover this in a little more detail, the market approach and even income approach. Net asset value approach is something which is used wherein you look at the current balance sheet of the company and see what is the shareholders value, the net worth. In this there is an adjustment where you do adjusted net asset value method, wherein what you can do is that you can look at say fair valuing certain things on the balance sheet, like say if the company has too much of say investment in real estate, or they have investment in some say companies, listed companies, then you might just want to do a NAV adjusted for these items, like fair valuation of say land or fair valuation of plant and machinery, because all these land, plant and machinery, their value in the balance sheet may be understated. So that is an adjusted net asset value method. Each of the method has its own relevance and importance and when it needs to be applied, like income approach. Obviously when you're looking at the earning generating capability, then you would like to do a discounted cash flow approach. Market price is more authentic, less subjectivity, because you're looking at price of certain companies which are trading, what is the price being paid. So it is kind of a level 1 input kind of a thing. If you look at the valuation hierarchy, that level 1, level 2, level 3. So level 1 is something which is observable, level 2 is something where you make a lot of assumptions. So market price is completely level 1. Even level 2, comparable company market multiple and comparable transaction also not exactly level 1, but still less subjective compared to say a discounted cash flow approach. And asset approach is mostly used in companies which are, I would say, something which are a company which has a lot of say, balance sheet heavy. By balance sheet heavy, I mean companies which are into say manufacturing, which has say plant, or say companies which are into real estate. There you would like to do say something like an asset approach. Coming to the first method, which is the discounted cash flow method, as the word suggests, discounted cash flows. So what you need to do is first try to find out that okay, what are the cash flows of my company, and then discount it to today's date, because we are valuing it as of today, and all these cash flows will come into the future. So the most important input which goes into a discounted cash flow is that you will need to first project the cash flows. And when I say cash flows, it would be like you make a proper profit and loss, proper balance sheet, projected balance sheet, and proper projected cash flow statement, and try to find out what is the cash flow which will come each year. And then that cash flow has to be present valued. By present value I mean is that 100 rupees which you will earn tomorrow is not worth 100 rupees today, because there is a time value involved. If I would have got today, I would have reinvested it, I would have got some money, right? So if 100 rupees is going to come to me to say after 1 year, I'll have to present value it depending on what is the risk associated with it. Now say 100 rupees invested in FD, I mean 100 rupees which I'll get in a FD, say 1 year down the line, I know FD is risk, I mean almost like risk free, there is not much risk, and whatever is the rate, say 6-7%, I'll discount it by only 6-7% for a year time. But the same may not be the case in case of a company. The company has more risk. I mean, so if you look at the risk-free rate of government securities are the least risky, and then it keeps increasing, like the cost of debt. But if you look at say a company, those are more risky, more volatile. So you will have to discount based on an appropriate discount rate. So if you look at, I mean DCF, as I told you, first you look at historical financials, then you look at the business strategy, because you try to understand what is the strategy of the company. Once you understand the strategy, you will know that how they're building the business plan, which should be more or less in sync with, say, how the industry might be going, how the country might actually move. Then you try to calculate what is the free cash flow to the firm or the equity shareholders, depending on what you are trying to value. If you are trying to value the entire business, you will take free cash flow to firm. If you are trying to value only the equity, you will take directly free cash flow to the equity, which means what will come to the equity shareholder. Then you will have to take an appropriate discount rate. I will show you how the discount rate is computed. And then terminal value to come to DCF. Terminal value is nothing but what happens is that when you are projecting the business plan, you will be able to project for say 3 to 5 years. But beyond that, it's very, very subjective. Okay, and generally also the thing is that beyond 5 years, I think even if there is a growth company, it will taper down to a normal growth, wherein it will have a steady growth, whatever the economy might grow. It might not grow more than that. So generally, if you look at any of the guidelines, like impairment testing guidelines under, let's say, Ind AS or even IFRS, they suggest that you should just go to until 5 years. And if you look at most valuation practitioners also, they will use a cash flow for say next 5 years and then apply a terminal value. Terminal value means value beyond 5 years. In certain cases, you might not stop at 5 years. You might do it say like 10 years, 15 years, 20 years. But that depends on, it's very specific to companies. Like say if you are valuing a toll project, I'm sure whenever you pass through a toll booth, you know that okay, if I have to value a toll booth, they have a certain life, I mean certain time duration which is the sanction which they have got from the government. So here it's the cash flows prediction is much more easier compared to say any other company, because they have a limited life of 10 year or 8 year, whatever is remaining. And there even the increase in say toll and all is defined by the government. And since it doesn't have a perpetual life, you might want to value it based on a 10-year life rather than say taking 5 year and then putting terminal, because terminal takes very long period. So you will not be able to restrict. That's why certain valuation of certain companies, you might have to take that assumption. Even in case of say certain power companies and all, wherein the life is restricted because of the power plant life, the plant life and all. Then you might have to do a discrete period, which is the projected period as a longer period than say 3 to 5 years. So once you add the discrete period plus terminal value, what you get is the total value of the company. And then you'll have to, so total value of the company means both coming to both the equity shareholders and the debt shareholders. You adjust for debt, cash, and then any surplus asset to arrive at the value of the company. Why do you adjust for debt? Because you are trying to find out what you want to pay to the equity shareholder. So you remove the debt, cash, because cash is lying idle. So it is something which is directly coming to your business and not getting captured in your cash flow. So add cash, surplus asset. Maybe the company is an IT company and they have say an investment, some say 10 acre of land somewhere in the middle of the city. They have a 10 acre land that is not being used in the business. So my revenue is not representing that surplus asset. So in order to capture the value of that particular surplus asset, which is not being used in the business, you add the value of that also. And if there are any other liabilities, say in that company has certain contingent liabilities, which is more or less sure that they might have to pay, then you might want to adjust for that also. So whenever you are doing valuation, you will have to make sure that you read the balance sheet very clearly, and also understand the notes within the, say, the annual report or whatever is the financials, just to see if there are any other liabilities or risks which are there for which you might want to adjust the valuation. There is something which I have covered actually, that in TCF the steps, it's more or less just a slide to summarize that. FCFF, FCFE, FCFF is nothing but the free cash flow to the firm, which means both to the debt holders and the equity holders. FCFE is only the equity holders. Ideally, whether you start with FCFF and then reduce the debt, you will come to whatever is the equity value, or you start with FCFE and directly come to the equity value. It depends on what methodology you want to follow, but generally most people want to follow the FCFF approach rather than FCFE. It's less complicated, so people want to do that. But even if you try to do a FCFE, it should not give a very different result to you. The only challenge I think with FCFE is that FCFE, you might have to take certain cash flows or interest rate or debt repayment. It's very difficult to project what would be the leverage in future. Maybe if the company is too leveraged now, then FCFE might not give the same result because you might want to repay the debt or something like that. So just someone has to be careful which method they want to use, but FCFF is generally preferred. Terminal value, discrete cash flow is something we discussed, that you project the cash flows and all. Terminal value, companies are expected that after certain growth stage, they will reach a sustainable growth rate. They will grow at the growth rate of the economy. So generally in India, it's taken at 4 to 5%, but if you look at developed countries, it's 2 to 3%. How do you calculate the terminal value? There are various methods. The most popular method is the Gordon growth model, wherein what you do is it's more of a capitalization. You take the earnings of the last year and divide it by the discount rate minus the growth rate. That is a formula. So once you use that, it will give you the terminal value. It's nothing but a shorter method. Even if you try to project the cash flows, say if the last year cash flows is say 20, and if you know that 5% it will grow every year, and you do 20 into 1.5, 20 into 1.5 to the power 2, 20 into 1.5 to the power 3, and keep doing it, and do the present value of all that, it will result in the same value. It's just that this is a simpler model. In one cell you can do that terminal value computation. Other could be exit value. Many times, many companies do not reach a sustainable growth by the end of the 5-year period. You might want to use an exit multiple. Look at what are the multiples at which the comparable companies are trading and try to apply that multiple. And the third is the salvage value, disposal cost. In case of companies, say like a plant, end of the life, there may not be terminal value, so you just apply whatever is the the winding up the company, you might get some value of disposal assets and whatever, or working capital winding up. So it's more to do with companies which have a very limited life. You do this kind of method. Third one. Coming to the risk factor, how do you do the? How do you compute the discount rate? Most prevalent methodology is the capital asset pricing method. Wherein what you do is that the discount rate for a company is weighted average cost of capital. Again, weighted average cost of capital means you will have to look at what are the various sources of capital, which will be either equity or it will be debt, right? So you look at how much is the cost of equity, how much is the cost of debt, and depending on what is the weight of your capital structure, what is the weight, how much you are financing through debt, how much you are financing through equity. Based on that, you're trying to find out what is the overall risk of the company, which is called the weighted average cost of capital. So first one is the cost of equity. So how do you calculate the cost of equity? You start with the risk-free rate, simple build-up. Risk-free rate, because that is the minimum discount rate. On that, what you do is you add the market risk premium, which is nothing but, say, any company, you look at, there are analysis to find out what is the market risk premium. There are studies done to determine the equity risk premium, because you are investing in equity. So what is the additional risk which you need to cover for that additional risk which you are taking? So that is called the equity risk premium. Generally in India it is like around 7%, but if you look at developed market, it is around 4.5% to 5%, like US and all. So you take risk-free rate, you add the equity risk premium, and then you also add certain unsystematic risk. So equity risk premium is like a systematic risk. Every company will go through that, has that particular risk, because that is prevalent in the market. Unsystematic risk is something which is very specific to my company. Say my company is very small compared to other companies. It might warrant additional risk. Or say my company has just started, is still in proof of concept stage. I would like to add a little more risk premium. So risk-free rate, equity risk premium, and then unsystematic risk, which is called company-specific risk premium. You add these three things, you will come to cost of equity. Obviously, equity risk premium has to be adjusted again for beta, because every industry doesn't have the same volatility. Because like if you look at pharma, it is a little less immune to market volatility. But if you look at, say, automobile sector, it is more I would say volatile with the market. So based on beta, the company's risk might increase. So once you have that cost of equity, second thing is cost of debt. What is the borrowing cost of the company? Depending on the rating of the company, you will be able to find out what is the cost of borrowing, or the management will tell you what is the cost of borrowing. You will have to tax adjust the cost of debt, because it's tax deductible, the interest. So you do cost of debt into 1 minus T. So you will come to what is the post-tax cost of debt. Once you have the cost of equity, once you have the cost of debt, just do the weighted average and you will come to what is called the weighted average cost of capital. And this is what is used for discounting the future cash flows. Debt to equity, what is the weight you should use? You should always try to use a market weight, because if you use a book value, book debt to equity, it will not give you the right perspective. The reason is that if you look at the equity in the books of a company, if they're making losses or if they are still in the early phase, the book value of equity will not represent the right value of the company. And anyways, what we are trying to do is also find out the fair value of the company. Rarely you will come across companies whose fair value is very close to, say, the book value, except in case of a manufacturing company or very, very asset heavy company. Otherwise, generally the fair value is much higher than the book value. So you should look at the book weight, market weights rather than book weights. And when I say market weights, you should look at comparable companies which are listed. What is the debt to equity ratio of those companies, the market equity value and the debt which is sitting in their books. That will give you an insight. If you look at only the book, you might look at the company being highly levered, which will not give you the right benchmark. Coming to the second method, which is the market price method. This is very straightforward. What is the company trading at? What is the price people are paying? Take that as the benchmark for the fair value. Again, you have to be careful whether the company is thinly traded or well traded. Generally, if the company's trading is more than, say, 10%, then it's considered that it's frequently traded and you can take that price. But if it's not well traded, you might want to use other methodology and ignore the infrequently traded shares price. Here also you have to be careful what is the purpose of the valuation, because different guidelines mentions different way of calculating the volume weighted average market price. Like say the ICDR guideline mentions that you should look at previous 10 days volume weighted average price. When I say volume weighted, means if you go to the NSE or BSE website, you will see how much shares have been traded at each price. And you will have to weight the share price, the transactions which are happening with how much volume is happening to come to volume weighted average market price. ICDR mentions 60 days and 10 days. If you look at SEBI SASTI guideline, it talks about 52 weeks, 26 weeks, 60 days. 60 days. So it depends on which is the regulation which you are doing. Accordingly, you will have to take the precise. In case it is mentioned in the guideline, you will have to take that precise tenure for volume weighted average market price. But in case you are doing it for say any acquisition or for any other purpose, then you might take based on your judgment, which could be even the price as on that date, or say for a longer period of 3 months, 6 months, depending on what is the purpose of the valuation. So the other one is the comparable company market multiple and comparable transaction multiple. So comparable companies, as I told you, I mean, you'll have to look at companies which are in similar domain, similar size, try to shortlist those companies, look at the market price of that company, so that is the equity value. Add the debt of that company, you'll come to enterprise value of that company. Divide that enterprise value by one of the metric, like say revenue, EBITDA, EBIT, whatever is relevant, you will get a basically number, right? Like if the enterprise value is say 1,000, revenue of that company is 10, which means it's trading at say revenue is 100, so it is trading at say 10 times EV by revenue multiple. You take that multiple, apply to your own company's revenue. Say my company's revenue is 5 into 10, 50. So 50 is my enterprise value of my company. What you need to be careful in this comparable company market multiple method is that your company should be good, very representative. The multiple which you are choosing, whether you should use a revenue multiple, enterprise value by revenue multiple, or enterprise value by EBITDA multiple, or EBIT multiple, or say price to earning multiple, it depends on the quality of data which you have and which is more relevant. Like if you are trying to value using revenue multiple, one of the important things which gets missed out is the profitability of the company, right? So it's always good to use a profitability multiple rather than say a revenue multiple. That is a better way, okay? But now within revenue, within profitability also, should we use the best profitability, which is the earning per share? No. Earning per share is again impacted by a lot of extraordinary items, and generally PAT is very, very volatile of a company compared to say EBITDA or EBIT, okay? Because after EBITDA and EBIT, there are a lot of things which goes in, which might be extraordinary, and so doing all those adjustments is difficult. So preference is always to use an EBIT or EBITDA multiple. Depending again on asset heavy company or non-asset heavy company, you should use an EBITDA or EBIT multiple. Because the revenue multiple might not show you the right picture. But again, if your company itself is not positive, my company is not EBITDA profit positive, forget about PAT positive, then I cannot use EBITDA or EBIT multiple. I might have to actually rely on revenue multiple and adjust my revenue multiple so that I take a, say if the revenue multiple is 10 times and I know my company is not profitable, the other company is profitable, then I might adjust the multiple and say that okay, I will not pay 10 times, I might pay say 5 times, 6 times. You will have to do those adjustments. Comparable transaction multiples is same like comparable company multiple. There the equity value is traded price. In transaction price, the equity value is nothing but the price at which the transaction has happened. So you take the transaction multiple, again apply on your company, you will come to the value of your company. So fundamental, I mean again relevant earning multiple, appropriate multiple, multiply it, you will get A into B, which is the enterprise value, adjust for cash, debt, everything, you will come to what is as the equity value of the company. This is just a slide which is interesting, as I was telling you, like you can look at earnings based multiple like EV by EBIT, EBITDA, revenue multiple, PE multiple. So when you're using a PE multiple, it's nothing but market capitalization by the total profit of the company. So you apply your company's earning, it will directly give you the market cap of your company, which means the equity value of the company. But when you're using enterprise value, what it gives is the value of the entire company, not the equity value. So you'll have to remove the debt to come to equity value. Asset based multiple, like price by book value multiple. This is relevant in case of say financial services company. There you do a price by book multiple because most of the companies in financial services space, they are marked up based on whatever is the fair value. I mean the fair value. The balance sheet is quite representative. So this is an important multiple in case of financial services sector. Then EV by total asset if the company is too asset heavy. Interestingly, there are other multiples also which are looked at in the industry. Like if it is say a hotel business, you might look at EV by room. how many rooms are there, how many operating rooms are there, or if it's a hospital, then you look at EV by bed multiple, how many beds are there, or if it's a say a telecom company, you might look at EV by subscriber, EV by average revenue per user, something like that. Then EV by megawatt, if it's a company which is into say power space, then you know that okay, 60 megawatt plant, this is the transaction which is happening at 60 megawatt plant, they are paid this much. Then you might use a EV by megawatt kind of multiple. So these are more of industry specific multiple. Generally people don't use that directly because it becomes a little difficult, but this gives you a good cross check whenever you are doing a valuation. Last one is the net asset value method, historical cost or replacement cost or realizable value. Again, as I told you that this approach is something which doesn't capture the future potential of the business. So mostly used in case company which is not doing well under liquidation scenario, or even if you're using, try to adjust it for whatever adjustment you can do in terms of fair valuing certain assets or certain liabilities. In case of startups, there are certain different methods. I will not get into the depth of these methods, but these are certain methods which are used for startup valuation. Startup valuation, doing a discounted cash flow, everything will all in the air, right? I mean, they will give you a projection where you might have 500% growth in the first year, 1000% in next year. Profit might be going from say negative margin of say 200% to a positive margin of 40% in 3 years time. Everything, I mean, it's very aggressive, right? Because again, it depends on the company's whatever milestone they have to achieve, right? So in startup valuation, doing the traditional method of DCF may not give you the right result. Or when I'm telling you startup also, I'm not talking about a startup like say Flipkart. Flipkart is not a startup, it's much more matured, right? So I'm talking about a very, very preliminary startup which is still in ideation stage, which is hugely negative profit making. The business model has not been established. In those cases, doing a discounted cash flow method, very difficult. Market multiple method, very difficult, because all the companies which are listed will have their business model verified, will be making profit or something like that. Transaction multiple, possible. But finding on transaction data, little difficult, because it's not available in public domain. There are certain databases which might be able to give you that, okay, transaction has happened in say SaaS companies at this multiple, then you can pick up that multiple and apply. That is one method. But otherwise, these are a few methods based on which valuation is done. You look at what is the multiple for say similar companies, SaaS companies, which has happened, and try to adjust your company's valuation based on that company. Like scorecard method, where you look at certain parameters like cash runway, management. There are certain inputs, 5-6 parameters. You try to relatively see what is your score in that 5 parameters compared to say another company's score, and adjust the multiple. That is the way scorecard method works. Then you have first Chicago method, wherein you look at multiple scenarios of that company, which is more like a DCF, but taking multiple scenarios, giving weights to those scenarios and arriving at a value. Then there is a venture capital method, wherein what you do is that today the company is loss making, but you try to say that, okay, 5 years down the line, this is the revenue which they will make or EBIT they will make. So based on that, what would be the valuation of the company at say 5 years down the line or 10 years down the line, and bring it to today's value to see what is the value of the company. Again, I mean, these are a little theoretical when you come to when you look at startup valuation. So I mean, these are methodology which is there. I mean, guidelines are there, but difficult to use. Very, very subjective. A lot of inputs are very, very subjective. So people try to generally benchmark it with say transaction in this space, or they generally like to keep it at say whatever is the previous transaction which has happened in this company, or that kind of benchmark. Next topic is discounts and premium. This is more to do with the stake you acquire. When you acquire a controlling stake, you would want to put a control premium. When you are acquiring, say there is a minority stake which you are valuing, you might like to do a discount for lack of control. Or if it's an unlisted company, there may be discount for lack of marketability. These are also certain adjustments which are done. One has to be careful on how much is the discount or premium they should apply. Okay, so market price method generally gives you the value on a marketable basis, but non-controlling, because these are based on the share price which any individual is buying, right? So you would generally like to apply some control premium on that. Okay. But when you look at discounted cash flow approach, it is generally based on the entire company's performance, assuming someone is controlling the company and they're doing the best capital structure deal. You don't need to apply a control premium. Similarly, transactions which you're looking at, whether the transactions is on a control transaction which has happened and multiple you're looking at, or a non-controlling transaction, depending on that, whether control premium will be applicable or not, and also whether you are valuing controlling stake or not. Okay. There are certain studies which are there which can help someone to see what is the control premium which should be applied. Generally this is based on say 7-day, 30-day premium to any company which was listed and has been acquired. So there are studies which people do and they say what is the control premium in different industry and all. Then there is DLOM and DLOC, discount for lack of marketability. This again is based on, there are certain empirical studies like restricted stock studies. You look at what is the restricted stocks discount compared to say a traded stock, you will come to what is the discount. Or you look at pre-IPO studies, look at pre-IPO, what was the value of the company, and post-IPO how it has changed. That will also give you an indication of control, basically the marketability discount. Or there are some advanced methodologies like say Schaffe model, Finalty model. All these are like long-term call put options kind of model. When you look at certain parameters that come when the company will go in for an IPO, what is the time? So based on certain research, they have certain formulas which helps you to determine the discount for lack of marketability. So this is an interesting slide. What happens in a acquisition? Some people have their own perspective on what is the value, and then the person who is selling has his own perspective of what he wants to sell. So here what I am saying is that there is a value of the company on an as-is basis, which is the minimum value, okay? And then there are certain synergies which only I can derive, and then there are certain synergies which everyone can derive. So depending on that, someone will start negotiating. So minimum is the minimum that everyone is ready to pay. So transaction generally doesn't happen below that minimum. Okay, what happens is the negotiation happens between that minimum and maximum, and generally closes in that pink line if you see, because if there is a synergy which everyone is going to derive, then everyone will put the price. Like say if minimum price is 100 and everyone knows that they can pay extra say 20, everyone is ready to pay because of that synergy, then the transaction might happen till 120. But then if it goes beyond 120, it is only some acquirer specific synergy. I have that synergy, so okay, everyone is bidding for 120, but I know I have more synergy, so I am ready to pay to 130 also. Okay, so this is how the transaction happens, wherein everyone has a pull factor and a push factor. So depending on what is the what is the synergy you are deriving out of any transaction, you might like to overpay for that, but ensuring that you don't pay for something which is your benefit, right? You might want to negotiate and keep it at lower. So this is just a presentation on how the how the synergies actually determine the price when you're doing an acquisition. Looking at the recent all the M&A deals and how it is being structured, what you will see is that there are a lot of trends which you will see now in all the mergers and acquisitions. So interestingly, what you will see is that the way people are structuring the transaction, that has changed, right? So people don't invest now in say equity shares, or say, forget about debt, we are not talking about debt too much, but they would like to invest in say convertible instruments, not in equity, because they want to somehow enjoy the upside also, but at the same time say remain protected also. So they might invest in say CCD, compulsorily convertible debenture, or compulsorily convertible preference shares, or optionally convertible preference shares. Because what happens is, when you have that optionality, you will get your principal back, and there will be a preference before others. Okay, so to protect themselves, they get into those structured instruments, wherein they might have rights like, say, liquidation preference. If the company goes for liquidation, I'll get before the equity shareholders. Or if I am, say, Series H shareholder, I mean, there are different classes of preference shares also. If I am entering as the latest round, I'll get a liquidation preference over others. Or I might have an anti-dilution clause, wherein in case the next round of funding happens at a lower value, what I will do is that I will generally try to, I'll put an anti-dilution clause so that my stake doesn't get diluted. In case someone comes at a lower price, you give me additional shares so that I'm protected. So all these structurings are happening, contingent consideration, like the negotiation thing which I showed you, right? I believe the value of the company is, say, 100, the other guy believes that the value of the company is 200. Fine, I will go ahead with the deal, I'll pay you 100. You achieve these target, I'll pay you 100 more if you want. So that is called contingent consideration or earnout. It's contingent on achieving certain milestones. This is a very, I would say, common structure which you will see in all the recent acquisition. You take out any acquisition of any large companies which they are acquiring, it is always structured as upfront consideration plus earnout or contingent consideration, and which has to be fair valued as per accounting rules nowadays. You might have call or put option. Again, someone is acquiring only, say, 70%, 60% stake. They might say a put option saying that, okay, I'll acquire another 40% at a certain price in future. So this is the way people are structuring the transaction nowadays, which is very interesting and making our life more challenging. So it's interesting to do these kind of valuation of structured instruments as well. M&A failures, I mean, most of the M&A, you believe certain price you are paid, but still you fail. I mean, what are the reasons for that? Price paid too high, synergies which you thought might come, doesn't come. So doing an acquisition successfully is different from doing a successful acquisition. I mean, completing the acquisition is not the aim, but what is important is the M&A integration which happens later, or when you are evaluating the transaction, whether you evaluated the transaction correctly or not, the synergies which you were thinking, or the price which you have paid. So the price which you have paid. So you have to be very thoughtful in the entire process of the M&A, right from, say, diligence which is being done, to the price which is paid, to the synergies which you are evaluated, tracking the company. I mean, I know that there are a lot of companies which fails in M&A just because of the cultural change which happens. They are not able to integrate because the key employees leave, because there is a cultural shock, right? So M&A fails. That also happens. There are certain cases where the operational synergies which was evaluated didn't actually materialize, and you end up realizing that you have overpaid for that company. So it's critical that those things are analyzed. There are a lot of times that there are people at executive level who make it happen, the transaction make it happen, but they're not very sure. They just want to close the transaction, not evaluating it. Failing to integrate operations, culture, assess the correct customer reaction, inadequate due diligence. So every M&A has. Generally, when I started my career, I used to look at diligence at, okay, financial due diligence. But now diligence is not left to only financial due diligence. There are other due diligence which every company wants to do now. Before acquiring a company, they go for an operational due diligence. They go for a commercial due diligence. Just to understand the commercial due diligence means just understanding the entire prospect of that company, or say an IT diligence. If it's an IT specific company and IT is very important, so they would like to do an IT diligence, which might even see whether they are prone to any kind of IT risk. There are HR diligence which they do just to understand the integration which is possible. There are other kind of diligences also which are done to ensure that when you're doing an M&A, it comes to be a successful M&A. So with that, I come to end of my slides. I'm happy to take any questions which you all might have.
What is the PPA you mentioned in the first slide?
Yeah, so purchase price allocation, what happens is that when you're acquiring more than 50% stake of a company, As per accounting rules, you need to carry out a purchase price allocation. It is IFRS 3R under International Financial Reporting Standard. Under Ind AS, it is Ind AS 103. So if you go through that standard, what it says is that, simple thing is that when I acquire a company, say I have paid $200 for that company. So to ensure that your balance sheet reflects what you have acquired for, that 200 million what you have paid, you will need to allocate it based on what is the assets which you have acquired. Now, so there may be certain assets which might be at book value. So you need to fair value those assets, okay, tangible asset and all. Then there are certain intangible assets, like say if you have acquired a company which is into FMCG space, brand may be very important. So you will value a brand of that company. There may be customer relationship. So what you do is 200 minus say 50 of tangible asset, then you will value say brand or say customer relationship. Maybe that might be constituting say another 50. Okay, so 200 minus 50 minus 50. So what is left is 100. So that remaining 100 will go into goodwill. So that is something which will come in the consol books of the acquiring entity. When they do the consolidation of accounts, in the standalone book it will be shown as fair value of investment in that entity. But when you are doing consolidated books preparation, you will show these amount, the customer relationship this much, tangible asset this much, and remaining going into goodwill. So what it helps is that generally, one is that it boosts your balance sheet. But there are other implications also, like if there are intangible assets which are amortizable, or then it will show it as an impact on your earning per share. And also there are other implications also, like how you are structuring the transaction. If it's an asset purchase agreement, any intangible which you recognize, those will be eligible for amortization as per income tax laws. So you will be able to get the tax benefit also on those deductions.
In the case of acquisition, the company acquiring the company is going to get sold. If they have got depreciation unabsorbed, that is the depreciation loss, carry forward depreciation loss for next 5 to 6 years. So how can they get factored in arriving at the enterprise value?
Okay, so
is there any direct metrics available, or is it just you have to include it as part of how it is being taken care of?
So as I told you, what we do is discounted cash flow, right? So what we try to find out, what is the cash flow in future. So if you have an unabsorbed depreciation, unabsorbed carry forward losses, okay. When I am computing the cash flow, my cash flow starts with the revenue, takes the cost, comes to say EBITDA, then I take depreciation, okay, and then I calculate also the tax outflow. So if you have unabsorbed losses, first year, second year, your tax will be 0. So your cash flows will increase, and when I am present valuing it, it will get captured in my valuation.
In case of suppose if a sole proprietorship is there, it gets converted into new companies being formed. Similar setup, so the assets gets transferred under this lump sale method. So they investor wants to acquire in the new company. So in that case, so what will be the methodology of valuation to be adopted? Is it a discounted cash flow, because this company is in existence for more than 10 years?
See again, when you tell me that what is the price should be paid, if I am going to acquire some company as a part of slum sale, what I will pay is whatever is the fair value. When I am looking at from a transaction point of view, not from any regulation point of view, okay? Because I would not like to pay more than whatever I am acquiring, right? As a buyer, I won't want to purchase it at lower than that, right? So I'll do methodology which makes sense. Like if I am acquiring through slum sale also, what happens is slum sale that I don't acquire the entire company, I acquire certain assets, right? But those assets as a together, as in conjointly, will be able to run a business, right? So again, I'll use the methodology like discounted cash flow or some method which is more appropriate for that particular business. If it's an asset heavy company, I might do a NAV. But mostly if it's through a slum sale acquiring say IT assets of a company or a running business, then I might as well do a discounted cash flow. Okay. So that is from a negotiation point of view when I'm doing an acquisition. But now when it comes to what is the guideline for calculating the capital gain tax in case of a slum sale, there is a different guideline for slum sale, that how the capital gain tax will happen to someone who is selling. That is a different methodology. They have some book value methodology based on consideration minus book value, or some book value minus something like that. I mean, to be honest, it's there, but I have not read through. But that is the way it should be done. But from a transaction point of view, when you are acquiring, I think it should be more based on what you think is appropriate methodology to value that particular business.
So, just a doubt. The market risk premium that we usually use in DCF. So, in India, which is the commonly referred source for market risk premium? Because typically internationally they use Bloomberg. There's also Capital IQ. But in India, which is the preferred?
See, market risk premium, even in Bloomberg or Capital IQ, you will not get market risk premium as such, okay? So when I say market risk premium, it is the equity risk premium basically, okay? There are methodologies to calculate it. Earlier it used to be published by Ibbotson for US, which is called Morningstar, Ibbotson, and now it is called published by Kroll, okay? It's a paid subscription. But generally, if you go to website also, they will mention what is the equity risk premium for say that particular market. Okay, so for US and all, they publish it. It is around 5.5% if you look at. Okay, now coming to India, there are two ways you can do it. Either the same thing which is being done by Kroll or Ibbotson for US market, you do it for India. Okay, in India also there is nothing but equity risk premium, nothing but you look at what is the historical return. Say from 1991 is when you will have the data after the post-liberalization, or maybe 2001 I think, because risk-free rate is not available below that period. So equity risk premium is nothing but what is the return in the market minus risk-free rate. Okay, you can calculate it as of today, but what you need to do is you need to calculate it for a very long period. Okay, so that you can do either by looking at what is the return in the Indian market over a period, reducing the risk-free rate at different time period, and then calculating the equity risk premium at each of these stages and see the average or geometric mean of that. That is the method everyone, if someone has to do the entire academic study and try to calculate equity risk premium, that is how you can do. The other simplified way is that you go to Damodaran's website, they give you the equity risk premium for India, for all the countries in the world.
NYU.
Yeah, NYU Stern, you go, you will get. That is the simplest. They do it for US market. And what they do is based on the sovereign risk of each of the country. Sovereign risk will give you the risk premium for sovereign risk, and then based on the equity versus debt multiplier, they adjust it and they try to find out what is the country risk premium. So equity risk premium of US plus country risk premium will give you the equity risk premium for India. So that will be also around 7 to 8% is what he is estimating. And in India also, few of the firms do that research, but I don't think they do publish it. They generally keep it for their own reference. And what you'll observe is that India, everyone is using 7 to 7.5% mostly.
Thank you, sir. Just a follow-up question. If I were to calculate, taking the historical period, what is the typical period that I should be considering? And do I exclude black swan events like the 2008 crash and then COVID pandemic?
See, generally,
or do we have to still?
No, generally what everyone does is that if you look at Ibbotson study, they are doing from 1932, okay, which is the Great Recession, 1932 to now, okay. And when you take a longer period, automatically these abnormal things will get normalized because you will take a lot of data points, right? If you look, you might not have access to that report, but I have seen that report. They do it for each tenure, like 1932 to 1933, 1932 to 1934, 1932 to 2014, 2022, and then even 1933 to same tenure. So each tenure they will do, and then take a geometric mean. So it will get normalized, okay. And they also do that adjustment for certain P expansion. I mean, there are a lot of things which they do, okay. And I have myself personally also done equity risk premium for, say, US market, okay, and all these things which you mentioned, the black swan and all those adjustments, even those I have looked at and seen that whether that, how that has impacted the equity risk premium. So, and anyways, see, when we are calculating the equity risk premium, it's more from a very long-term perspective, okay. There are two ways to do an equity risk premium computation. One is looking at historical, what is the return they have generated. Second is looking at a progressive, looking at nothing but like a discounted cash flow. you look at Sensex. What is Sensex trading currently? What is Sensex constituents? Project the earning of those Sensex constituents and discount it today. What should be the discount rate which will give me the current Sensex value? That is the equity risk premium. That is another way to look at it. But is that you'll have to do that thing. All the Sensex companies weighted by their, their weights in the index, okay, or BSE 500 if you want to take more, because that will be more diversified. Project the earnings of those companies, discount it. So discount it will give you the discount rate. Now from that discount rate, you just remove the risk-free rate, you will get the equity risk premium.
Thank you. Thanks so much.
You mentioned newer types of investment options which are being pursued by the investors, particularly where you get an assured or sort of a preferred payout in case of a liquidation. I'm just wondering, how is it even legally possible to have that kind of a structure? Because by definition, all equity shareholders should be treated equal, right? So how does that kind of a product get structured, and what is the legal feasibility? Comments on that.
See, today if you look at any of the startups, forget about the matured companies, there you will not see these instruments because the risk is limited. So you don't want to get into unnecessary those kind of structured instruments. Where do you get into the structured instruments? Where you feel the risk is higher and you want to be protected. All the financial investors, I do valuation for a lot of private equity clients. Okay. All the private equity investors, when they invest in a company, or any strategic investor when they invest in a company which is pre-revenue, pre-profit stage, or are in the initial stage, they never invest in equity. So when I tell you they invest in differential rights, it's not in equity instruments. They go into preference shares. And what they do is not even preference shares, which is the normal preference shares. They get into optionally convertible preference shares, compulsorily convertible preference shares, optionally convertible debentures, compulsorily convertible debentures. And if you go through the shareholder agreement when they enter into a transaction, there they mention the rights. And if you go through that agreement, the rights, it's full of different kind of rights. I just give you an example of 2-3 rights, like liquidation rights. So if you go through that liquidation rights, they clearly mention that, and it is signed by all the parties, all the shareholders. So it clearly mentioned that, okay, I have invested in Series E. When the liquidation happens, this is the hierarchy in which the payment will happen. Okay. So first it will be paid to Series H, then Series F, Series G, or it could be that, okay, first all the preference shareholders will get proportionately based on their proportionate amount of investment. Or it could be that no, first I will get at say 14%, if I get 14% then only someone else will get. It depends on how you are bargaining and at the stage when you are entering, how much you want to negotiate. So it's never invested in say per se equity, common share. It's in a structured instrument which may convert into equity shares depending on if the IPO is happening, they will convert because it's preferable for them, right? How they structure it, it's optionally convertible. Now what is the option? I'll convert it only when I feel the company's value is more than that, right? Which is when the company is going for IPO, which means the value will be more than what I would have invested, much more, right? So I'll convert. Or there may be a time duration that, okay, after 10 years you choose whether you want to convert or redeem. They will opt for redemption if the company is not performing well.
So basically what's happening here is the preference intersect between the various equity side investors, right? You definitely cannot have a similar scenario where you prefer them over, let's say, an external creditor. For instance, if this company goes to an IBC resolution process, then the IBC code will take over, in which case the financial operational creditors will always be first in line.
Yeah.
So only after they have been settled, and then when it comes to settling equity, then that is when these terms will play out, right?
Yeah. Always the first preference is always to the external debtors, creditors, and then it comes, because though they have a preference, but it's only from a equity shareholder point of view. I think first preference, even from a debtor and creditor point of view, depends on who has what rights, right? So these preference shareholders, I don't think in any case, and generally what you will observe is that also that wherever there are preference shareholders, you will not find debt, because that is the reason why all the startups don't have debt. They have more of preference shares, right? Because debt holders will never invest. Why will why would they take a debt or a bank give them debt? Because that debt will be, and they don't have the capability to repay the debt, right? Or pay, or even service the debt. They don't want to invest in that. So all the new age startups, if you look at, they don't hardly have debt. Any other questions? Okay, thanks everyone. It was nice to give the session to everyone. Thanks.